There's a bit of a schizophrenia here about what actually is the path to a peaceful place for the market.
There's finally an awakening to this shift in focus away from those early players of the AI trade.
There's likely to be a broadening of the market.
You get nervous at one point on the AI trade every single year, apparently.
There's just a lot of fragileness in the market, but the overall sentiment, I think people are still pretty bullish.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Stocks inching higher to close out the best quarter in 6 years. Chip stocks leading the pack with a near record-setting performance, some 46% this quarter, raising concerns about an overheating AI trade, and European central bankers expressing concern that the inflationary shock isn't over, even as oil prices go down. Annmarie, it seems like John has taken your advice and head over to Portugal to analyze the lay of the land. But the lay of the land right now is essentially the inflation problem is not over.
Inflation problem is not over, but it's different when you look at Europe versus when you look at the United States. When you look at Europe, and Philip Lane was talking about this, the chief economist of the ECB, to Francine Lacqua in Sintra. She's very lucky to get that assignment. Basically saying that this is the case where they need to rethink about how there's going to be knock-on effects. And Europe is, of course, so much more vulnerable when it comes to energy prices. And what Philip Lane wants to see is basically, and consumers basically want to see in Europe, that they need to see the current peace agreement convert into something more durable. In the United States, a little bit different when it comes to the inflation story. Is it really about energy or something else?
There is a similarity, though, between the U.S. and Europe right now, and that is that forward guidance is dead. And that's what we heard from Christine Lagarde. Stop trying to expect it. Inflation's a problem. That's going to be a much simpler and single mandate type of situation. And that focuses the attention on oil, despite the fact that nobody wants to focus on oil because it's a moving target. We're poised for the biggest quarterly decline in oil prices going back to 2020. Is there actually a meeting taking place today between the Iranians and the U.S. delegates in Doha?
Well, not sure if they're going to meet face-to-face, according to the Iranians, but both teams sent officials. The United States says there will be these meetings. They sent Jared Kushner and Steve Witkoff, the president's special envoy, and his son-in-law, to these meetings. But the Iranians are saying, we're going to be in Doha, but we're not exactly going to be meeting face-to-face with the American counterparts.
So the great housewives of the international scene continues. Right now, we are also expecting a slew of data coming out this week, starting off with the JOLTS data coming out at 10 a.m. Eastern today. How much does the data indicate that there is going to be some sort of overheating in the underlying economy? And then ISM manufacturing tomorrow. Part of the problem is, even if we're data dependent, we don't understand what the reaction function is. Do we have a better sense of that after the speech that we get from Kevin Warsh tomorrow?
Hopefully, but what has Kevin Warsh said so far? I'm not going to speak unless I have something to say. Does he have something to say in Sintra, Portugal? Will we get any sort of inkling on either his reactionary function, maybe who is leading these task force, and if we can read into anything he says about forward guidance?
Well, right now we are poised for the best quarterly gain for the S&P going back to 2020. Looking to build on that, sort of, if you can consider this anything of a move, about a 0.1% gain that could go any way. Nonetheless, led by the NASDAQ, which is notable. We saw that outperformance once again yesterday with, guess who? The hyperscalers making a turn at the top once again. When you take a look at the bond space, you can see just utter calm. I mean, really, the more that central bankers talk and the more concern there is about a lack of reaction function, the less bond yields do. We're still at 4.1% the 2-year and still locked in there at 4.85% on the 30-year with a little bit of a dovish tilt this morning. Really, the news overnight and the action in markets was with the Japanese yen falling to the weakest going back to 1986. Over to you, Bank of Japan. Are you going to raise rates? Are you going to respond to that in the face of what globally seems to be an inflation shock that is raising concerns in central banks around the world? Coming up this hour, we've got John Stoltzfus of Oppenheimer, with equities looking to close out the quarter on a high note. Henrietta Treyz of Veda Partners, as Iran seeks more control over the Strait of Hormuz. And Matt Hornbach of Morgan Stanley, with investors awaiting a busy week of data. We begin this hour with stocks holding steady following a rally in tech. John Stoltzfus of Oppenheimer, one of the bulls, writing, with S&P 500 Q2 earnings season several weeks away, news flow, eco data, and developments in the Middle East are likely to drive market sentiment. John joins us now for more. John, great to see you.
Great to see you as well.
Driving sentiment up or driving sentiment down?
Well, you know, driving sentiment up, I'd say right now, we'll have to see the way the jobs number looks at the end of the week, or well, on Thursday, a little bit early this week. But we have to say things are still remarkably good, and I think the operative word remains resilient. Resilient doesn't mean robust. It means resilient, not unchallenged. And every time we get the challenges towards that resilience, whether it's an economic data piece, a piece of information related to a setback in the negotiations in the Middle East or whatever have you, it seems to be overcome by that resilience factor that either shows earnings better than expected, debt in better situation than it actually was thought to be when the bears and the skeptics start trying to drag things down. And fundamentals remain very positive. And that's what you got to, we watch the fundamentals. I don't go after the technicians. I respect them, but I'm intermediate to longer term investments. And, you know, we're all on the upgrade cycle in terms of tech. Whenever the drama and the headlines are against technology, I tell my team that's many years younger than I am, I tell them, I said, let's sell throw away the PC and the laptop. Let's look for an abacus, and for a slide rule, we'll be all set.
I see what you're doing.
And forget about the GPS when you get in the car. You need a yellow legal pad, write it in pencil, get a flashlight, get a map. You know, we're not going back.
I can already see the fights ensuing in the car as you try to figure out the directions, because any of us old enough to remember that, and the parents in the front. Either way, I am wondering, though, if there has been a shift in tone, and whether we've seen that with respect to a real question about how much spending there actually can be on semiconductors, given the expense, given the pushback that you're seeing in markets, and given the fact that debt investors are starting to get a little pickier.
I think without a doubt, you feel it and you see it, and it goes in this operation where you go day to day, risk on, risk off, tech on, tech off, back and forth. It's an argument, but the good thing is I think it puts players on notice that be careful what you're doing, relating what your expectations are on this. And for investors, the idea is you have to be aware that there will be failures. There will be things that will not work out in AI and other things that will. Just think back on the internet. And we don't think this is like the internet bubble. This is very different. Both business and the consumer have tech deeply embedded. We're dependent on tech in our lives. So, you know, overall, we just think uncertainty is very common in life, and it's always in the markets. There's an old adage that the markets don't like uncertainty. They love uncertainty. The traders have an opportunity to go after the next vanity plate for the next new trophy automobile. And for intermediate to long-term investors, look for babies that get thrown out with the bathwater.
Do you see this as a 2026 story, or is this really more of a 2027, 2028 story?
I think it's genuinely 2026 story. I think we have to see how 2027 develops going forward, because the changes today happen so much more quickly than ever before. Yeah, as you know, I always say when I come on the show, I've been in this business for 43 years, so I've been every boom, bust, and recovery cycle since 1983. And the markets today, because of the news flow and the accessibility of news flow on organizations like Bloomberg, as a result of that, the markets discount both bad news and good news very quickly. And it's a remarkable thing. It's actually a benefit to the markets. As I said, it keeps everybody honest. You get shaken up every so often, and you realize trees don't grow to the sky. It's like, you know, you don't feel like, well, I'm not going to mention some of the people from the other busts in the past. I don't want to fight with people from the past, some of whom are in their graves now.
Listening.
But the point is the reality is this is a different world today. You have to look at structure, and the structure of everything has changed via social media, technology that's utilized in business for pleasure, leisure, what have you. And it's a dramatic change. And but you know, there's a whole generation that believes that we never had payphones or we never had rotary dials on telephones.
So if you're concerned, though, or a little bit concerned with the AI trade, how are you hedged against this?
Well, what I'm doing is, if, for instance, we have a dividend opportunity portfolio that I'm the manager of, and I can't tell you what we own in it, but I can give you this idea. We barbell it. So we have tech. We also have telephone companies. You know, we have utility companies in it. It's all 11 sectors. It's diversified, and it has an ability so far over the 9 years that it's been in existence to weather significant volatility and bounces very well, like a healthy count bounces, not like a dead count bounce.
Do you think that the rotation that we've been seeing with the equal weight and the Russell 2000 outperforming can continue? Do you think it has to keep performing in order to reach some of your targets?
No, I don't think it's the end for large caps. I just think, and I don't think it's either the end for this run that we've seen in small caps. I think there's room on the stage for large, mids and smalls. We believe you have to be selective. You got to look out for the junk, look out for the value traps. We like growthier value and GARP growth, which is growth at a reasonable price. So in technology, for instance, we don't we own some of the names you think of right away in tech, but we own other names that most people don't think of that support those names.
You've been in the business for more than 40 years, as you were saying. Can you characterize this moment to give us a sense of how different it is, or how similar it is to previous cycles of booms and busts, just in terms of sentiment and in terms of novelty that a lot of people feel?
Great question. I think markets are often considered to be mostly about fear and greed. And they're not. It's fear, greed, and need, genuine need. And today, one of the things that structurally has changed the market so much is that the private investor, who for many years was treated with disregard by the institutions, today is in many ways more important than the institutions when it comes to the amount of direct investments and indirect investments that the private investor holds. It used to be if you worked for a wirehouse, as they used to call them, they would tell you if you find a qualified client, offer them 5 stocks for diversification, maybe a tax-free municipal bond or a mutual fund. Today, with the products that are available today, an experienced advisor can build a portfolio for an individual or for a family office that will rival major institutions, or that can rival major institutions. And they're investing seriously. It's not for cocktail party chatter. When the private investor used to come in, usually once the market was up 15 or 20%, they'd rise it up, they'd ride the last 5 or 10%, then get disappointed. Today, they come in much earlier and they stay. They recognize that studies that have said that it's more important to be in the market, that time in the market is more important than timing the market for intermediate to longer term investors. And they're investing because Social Security will likely not be anywhere near what it was for the prior generations. And lastly on this is the other part of this is you no longer have defined benefit retirement plans for most companies. So people need to make investment decisions that are serious.
John Stoltzfus, wonderful to have you. Thank you so much for being with us.
Thank you.
John Stoltzfus of Oppenheimer. And it's sort of the definition of how the, quote, dumb money has become the smart money from a lot of people, because ultimately that is the crowd that will set the tone.
And look at SpaceX, how much they allocated and how much these retail investors actually bought in. Similar to John's point, this is making up a huge part of the market. And it's no longer just the institutional investors.
Yeah, it's a structural shift. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Quinn. Vonnie.
Good morning, Lisa. Iran's deputy foreign minister signaling Tehran remains firm on maintaining control over traffic in the Strait of Hormuz. The remarks to state television coming ahead of the next round of talks with the U.S., supposedly scheduled in Qatar today. The yen sliding to the weakest level against the dollar in 40 years, a move that has traders on high alert for authorities to intervene. The government already spent a record $72 billion from April to May defending the currency. And in sports, Paraguay delivering the biggest upset so far in the World Cup, sending 4-time champions Germany home in a dramatic penalty shootout. Germany's game-winning corner kick was overturned after replay review, ending their first appearance in the knockout rounds since they last won the tournament in 2014. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. I gotta say, shootouts just are not satisfying.
I know, and there's been a bunch of them. And Netherlands lost, right? And I'm pretty sure the individual, the German economist who predicted 3 prior World Cup winners, had Netherlands winning this World Cup. So things are really just...
Way to pour salt in the wounds, Annmarie. You're like, you got it wrong. Right, up next, heading back to the negotiating table.
Going to Qatar. The meeting in Doha is going to be perhaps important, perhaps not. We're going to find out.
And Treyz of Veda Partners joins us next. This is Bloomberg Surveillance. Good morning. Giving a little extra heat to what could be the best quarter for the S&P going back to 2020. We just see a little bit of a lift across the board. A really violent rotation throughout the month. We've seen, of course, semiconductors outperform dramatically. We saw the hyperscalers lose steam with potentially the worst monthly loss for Microsoft going back years. At the same time, equal weight coming back. You see really an even kind of advance this morning. NASDAQ futures up 0.2%. Russell 2000 up 0.1%. When you take a look at the bond space, really quiet but not quiet over the past quarter. The 2-year yield has risen 31 basis points over the past 3 months. This morning, continuing to disinflate to 4.1%. On the long end of the yield curve, really quiet. That yield curve flattening has continued at 4.85%. And in the oil space, we're all watching this to understand just how much heat can be taken out of the inflation trade. A little bit of a lift here, but just amazing to see how much oil prices, Annmarie, have come down over the past 3 months.
Right, because the energy is moving. Even if we have some tit-for-tat attacks over a few-day period or rhetoric that seems sometimes particularly hot, either from Tehran or the White House, the fact of the matter is more vessels are getting through. And even as the world deals with drawing down inventories, the fact that oil is moving is a positive sign.
Yeah, so either way, you get, of course, job owning, you get some attacks, and then you have negotiations under surveillance this morning, heading back to the negotiating table.
They're going to Qatar. I think they've already left, or they're just about getting ready to leave. So we'll see how that goes. But we're doing very well on that front. But the meeting in Doha is going to be perhaps important, perhaps not.
Here's the latest. Peace talks between the U.S. and Iran resuming in Doha. Tehran demanding greater control over the Strait of Hormuz. Bloomberg's Tyler Kendall joins us for more. Hey, Tyler.
Hey, Lisa, good morning. Well, it is becoming increasingly clear that Iran is determined to maintain its control over the Strait of Hormuz as we head into this next round of potential talks today. New comments overnight from a top Iranian official reiterated this intent to create a structure to oversee the strait alongside Oman. But importantly, this official went on to say that Iran is determined to do so with or without its neighbor. Now, over the long term, that may be easier said than done as more ships choose to transit through the strait, through that corridor that hugs the coast of Oman in a bid to get further from Iran, because we are seeing this uptick in confidence when it comes to commercial shippers, as new data analyzed overnight shows that at least 24 commercial vessels with the potential to carry 11 million barrels of oil transited through yesterday, though this is below pre-war levels. And that's adding to the stakes ahead of these planned negotiations, as the White House says that Special Envoy Steve Witkoff and the president's son-in-law Jared Kushner are going to lead these talks, though importantly, we should mention that we haven't gotten at least public confirmation from the Iranian side, though the understanding is there is a delegation on the ground this week in Qatar. And then, Lisa, of course, we're also tracking what the potential domestic pressure looks like, because President Trump took to Truth Social last night to reiterate his threats against retail gasoline or gasoline retailers to bring down the costs at the pump, though we know that a lot goes into setting that final price. According to AAA, today's national average stands at just below $3.85 a gallon.
Tyler Kendall, thank you so much. And we'll be catching up with you throughout the day. Henrietta Treyz of Veda Partners writing, negotiations are underway, but the things the White House are trading away on the sanctions front pose a very real risk to the Western financial system. Henrietta joins us now for more. Henrietta, great to see you. Thank you for being with us. What are you watching today, if there are negotiations between the U.S. and Iranian delegations, to understand exactly what the U.S. is getting in return for alleviating some of these sanctions?
You know, the sanctions front, I think, is just so critical watch, obviously, because the Western banks, the Western corporations, insurers, NATO nations, the entire Western globalized world needs to follow along the trajectory of whatever the U.S. decides is okay here. Lawmakers have to sign off on it, and it needs to be codified in a way that everybody can get comfortable with. So this is going to take a very long time. I do not anticipate that this is going to be one of the issues they can resolve right now or even in the first half of the 60-day window. We have 60 days that go till August 20th, if my math is correct, but everybody is widely expecting for this to get kicked further beyond that because these issues are just so thorny. I don't expect that we'll have a conclusion on what the sanctions or what the tax front is going to be today. And I think that's going to be the trickiest part of this whole negotiation. I mean, we know what the nuclear file should look like. The president has traded away ballistic missiles, but the sanctions stuff just has so many individual components that need to be worked through. I think it's going to be a real time-consuming component of these talks.
Henrietta, deja vu from the Biden era, but Trump on Truth Social yesterday saying gasoline retailers must get their prices down. He's saying that they're price gouging and that if they don't do something, there's going to be big problems that lie ahead. As we are in peak driving season, as of course we look forward to the midterm elections in November, is Congress still weighing potentially what they could do to ease some of these affordability concerns for consumers?
Yeah, life comes at you fast. No, Congress is not considering anything like that at all. When we talked about a gas tax holiday with staff, it was really clear that they need pain to be exponential. We saw last Wednesday how Republicans really did stand up to President Trump. And they were saying, give us a briefing on the war. Let us know what's going on. What is the agenda? What are our goals? What can I tell my constituents when I go back home? Why aren't you passing the housing bill? They are not in a, hey, let me help mode. They are not in a, let me pass a gas tax real quick and get you a holiday that'll, last 90 days. There was a bill that was introduced earlier this spring that would have suspended the gas tax all the way through November. That's not being discussed right now. Indeed, the stuff that they are talking about is an $88 billion supplemental that would provide $67 billion to the Pentagon and $11 billion for the farmers as they deal with the fallout from tariffs and also higher fertilizer costs as a result of the Strait of Hormuz. So this has become more of a localized issue, I would say. And there's nothing percolating that I've picked up on in my time on the Capitol this week or last week around gas taxes.
What will get done before the midterm elections? We know the speaker is now attaching the Save America Act to the annual defense policy authorization bill. Is that going to swing?
No, definitely not. The Save America Act, and my favorite senators to look at for that, and the favorite state that I have is really Alaska. You're effectively disenfranchising the state of Alaska, who'd have a really difficult time getting their voters back on the rolls the way that the SAVE Act is written right now. Lisa Murkowski gives really impassioned speeches on the Senate floor about this very topic. So if the House wants to send it over so Speaker Johnson can, get rid of some of the logjam in his chamber, that's all fine and well. He's done his part. But Leader Thune is not going to fire the parliamentarian. As the president tweeted about yesterday, he's not going to kill the filibuster. And the SAVE Act just doesn't have the votes. So the president is very single-minded about this topic at the expense of the housing bill, at the expense of some other things that the administration needs to see, like avoiding a government shutdown at the end of the fiscal year. But we're not going to get the SAVE Act.
Henrietta, it's amazing that we are almost a half an hour into the show and we haven't talked about the Lisa Cook case and the Supreme Court decision that allows her to stay in her seat as governor while the proceedings that the administration has brought against her continue. How significant is this in your view? Do you think that the administration is just going to back off and then we're going to see Jerome Powell just fade into the distance and allow them to have an extra seat in the Fed?
Call me crazy, but I think this is an amazing outcome for the president. I think having Lisa Cook and potentially Jay Powell staying on through the duration of his term, now that Bill Pulte has threatened her with yet another round of lawsuits and an actual try to identify cause for firing, this means that Powell could stay, Lisa Cook is there. Trump can't go after Kevin Warsh. That's his guy. But now he's got two boogeymen instead of just one. And if the Fed can't reduce inflation, interest rates because of inflation as a result of either the combination of the tariffs or the trade war, the hot war with Iran, this is great news for the president. Now he's got two folks that he can continue to hammer, blame inflation on them. I think it's okay for the president if he wants to take the win here. But obviously, the Supreme Court rejected his attempt to fire the member, and I think the street really received that very positively. I know Jay Powell was pleased.
Henrietta Treyz of Veda Partners, thank you so much for being with us. We've seen this before, Annmarie. I mean, there have been chances to take the win and just back off when it comes to a case that a lot of people said threatened Fed independence. You did see a market move, more confidence in the long end of the yield curve after this court decision was released. He hasn't in the past.
More confidence, though, potentially from Chief Justice John Roberts. He wrote this in writing for the majority. Congress has limited the president's power to remove governors for good reason. They were focused on monetary policy in this ruling.
Yeah, very much so, because it was very different than another ruling having to deal with certain federal institutions. Coming up next, we're going to be talking about the tech trade. Are things getting overheated? What do you think Dan Ives has to say of Wedbush? Probably not. He sees tech giants continuing their war. Plus, Yahira Anand with your Morning Movers. Digital realty falling. This is Bloomberg. Just amazing to think that 3 months ago we were worried that potentially oil prices would go to $200 a barrel and suddenly that would torpedo all growth. We just are potentially poised for the biggest monthly gain on the S&P going back to 2020. On the NASDAQ, we're looking at quarterly gains of some 23%, really led by the semiconductors, a real turn under the surface in the tech trade. And the Russell 2000 hitting a record high, eking that out yesterday overnight. Today, adding to that, building throughout the morning. Session growing more bullish as we speak. 0.2% gain on NASDAQ futures. The S&P and Russell up a bit more than 0.1%. In the bond space, it's been the opposite. I mean, the rally has come despite what we have seen, which is yields substantially higher. In the quarter, up about 30 basis points on the 2-year. Suddenly, people pricing in the idea of a rate hike. We have taken a lot of heat off of that, though, and I think it is important to note that the rhetoric has been somewhat mixed from Fed officials and a real question about what the jobs data is going to show with JOLTS and then, of course, the labor market report. Right now, on the 2-year, 4.1%, kind of anchored there. And meanwhile, this to me is catching my attention. And AMH, I don't know. You just have to wonder at what point the Bank of Japan is going to step in here. You're looking at the weakest level on the Japanese yen going back to 1986, 162 per dollar. And you just start wondering at what point they have to take action despite some of the tone from the government.
What's the new red line if they don't take action now? Are we going to see intervention like we did in 2024, or potentially are they going to let this ride? And a lot of this is coming from the prime minister and what is going on in the fiscal space when it comes to Japan. More fiscal expansion. Potentially, maybe we'll get more, press releases about a certain phone call between the Treasury Secretary and Japan, and maybe try to help them verbally. I think for this market, though, they're going to have to wait and see what you just said, what JOLTS do, what we get from the non-farm payrolls report on Thursday. What does that mean for the U.S. dollar, and potentially does that help in terms of what's going on in Japan?
Regardless, we are seeing a dollar strengthening, and that's actually a reversal of what a lot of people thought. And there are some people raising questions about how much that could be the ultimate pain trade. 3 hours away from the cash open, here are your morning movers with Yahira and Yahira.
Hi, Lisa. We start with Digital Realty. Those shares under pressure this morning, down 5.3% after agreeing to buy Blackstone stakes in 3 North Virginia data centers for $3.5 billion. The move itself expands its footprint in the world's hottest AI data center market, but investors are focused on the financing since Blackstone will immediately be selling at a discount the 12 million shares of Digital Realty shares it's receiving in the transaction. Turning to another name moving to the downside, this is Concentrix, plunging 23.7% in the pre-market. It's a call center company, and it cut its full year outlook, and it's yet another example of AI disrupting the industry. Bloomberg Intelligence writing that AI is shrinking demand for its traditional business faster than it's growing its newer AI services. And we end on defense with Aero Environment. Those shares soaring nearly 25% in the pre-market after the drone and defense technology company beat expectations and issued a strong sales outlook. It's saying that demand for its drones and counter drones technology is continuing to soar as governments continue to ramp up spending in that area. Lisa?
Thank you so much, Yahira. Honestly, the single-day moves in specific names has just been off the charts, whether it's the likes of Microsoft or Amazon, or whether it's some of these smaller names. I mean, that to me, that single-name volatility, really notable.
Unbelievable. Sometimes you can see the S&P 500 or the Dow Jones Industrial Average not really do much, but under the hood, you are seeing sometimes double-digit gains or losses on a single name. And to John Stoltzfus' point, some of this has to do with actually also what's going on with the retail traders and investors.
Yeah, who have been, in some ways, the smart money. On our radar this morning, the Supreme Court ruling that Fed Governor Lisa Cook can keep her job while fighting President Trump's efforts to fire her. The court also expanding the president's power to remove the heads of independent agencies.
Should we expect more firings as a result of this ruling?
I don't think so. It gives me the right, and not me, it gives a president the right to do what the president should have the right to do.
The ruling overturning a 91-year precedent curbing executive power. Meanwhile, the yen falling to its weakest level against the dollar in over 4 decades as Japan's bond yields climb higher. The move sending import costs soaring and putting investors on alert for another potential BOJ intervention. And meanwhile, authorities in Taiwan raiding the offices of chipmaker Supermicro in addition to several residences. The raids tied to an ongoing investigation into alleged smuggling of Nvidia chips into China using supermicro servers. Is this an issue of Taiwan trying to preserve their sovereignty, trying to preserve the relationship with the U.S.? Supermicro shares up 1.75% today.
I think a few things are going on here. One, re-exporting chips from Taiwan to China is not a criminal offense in Taiwan, but Taiwan has been under immense pressure from Washington really for years to try to stop some of this. The Financial Times last week had this leading paragraph. Nvidia's AI chips have more than doubled in price on China's black market as the U.S. crackdown on illicit exports collides with strong demand from Chinese companies. So you see this insatiable demand from China for a lot of these chips and technology that has export controls from the United States. And if it's not illegal to do so from Taiwan, potentially that's where it's coming from. But you've seen this push and really a heavy hand by Washington to get Taiwan to crack down on that.
And this comes amid a huge sovereign push into AI as AI continues to perform. U.S. stocks on the verge of completing their best quarter in 6 years. Tech, however, on track for its worst month since March of 2025. Dan Ives of Wedbush writing, tech stocks have way oversold in June. They ultimately represent major buying opportunities as these bearish narratives have overshadowed the future massive growth prospects. Dan joins us now. And of course, when we're talking about tech, we're talking about hyperscalers in particular, which have been the huge losers until yesterday, where you actually saw a little bit of a turnaround. Why do you reject the notion that people are pushing back against the spending plans of some of these tech behemoths?
Look, the hyperscalers is $700 billion. I mean, that's what's funding the AI revolution. I mean, when you talk about memory chips to Nvidia to everything else, but that's just the first phase. Because what the hyperscalers are doing is, this is the build out. It's Vegas Strip building in 1955. But ultimately, the monetization now is going to come. I mean, when you look at Meta, they're not just spending to spend. You look at Microsoft, they essentially own the enterprise. Alphabet, 5% of their customers have gone to the AI path. Same thing with Amazon. So my whole point is, you've had this tech rally, but Mag 7 right now, penalty box essentially. I think it significantly outperformed second half of the year. And I think earnings season, as we see in July, and that's going to be a huge validation moment for big tech.
So the Vegas Strip maybe is a decent analogy on the just actuality of it, not in the scale. I mean, we're talking JPMorgan expecting $5.5 trillion of spend on CapEx spend for AI heading out to 2030. We're talking about massive numbers that are accelerating, not decelerating. And capacity-constrained companies, right? I mean, some of these companies have said, we can't give you all the compute you're looking for. So how do you see them monetizing without raising prices enough to really trickle into the cost of what everybody is spending on an everyday basis?
Yeah, well, first off, for every dollar spent on, let's say, an Nvidia chip, there's an $8 to $10 multiplier across the rest of tech. So that's extremely important in terms of what you see in terms of, you talk about some of the single stock moves, just the broadening out what we're seeing in terms of tech. And you could argue for names like Caterpillar and others. But when it comes to hyperscalers, look, it's an arms race. That's why the question is, like, can they actually cut CapEx? They can't. In other words, like, you're diving into the deep end of the pool. Because if they cut back, then they go behind others in line that will clearly go ahead of them. Anthropic, OpenAI, ultimately, as they go public, they'll just have more and more cash. And I think that's the reality right now. And to those, the bears will be like, oh, it's spending to nowhere. It's the opposite. I mean, you're essentially building out a new economy for consumers, enterprises, and for the first time in 30 years, the U.S. is ahead of China when it comes to tech.
But what about demand destruction? Does that happen, especially when we see something like Apple come out and across the entire suite having to raise prices?
Sure, look, I mean, there's going to be negatives, just like we see with memory, because there's a limited amount of memory chip players. You can't just
So there is a breaking point, though.
There is a breaking point to a point where, like, okay, if you continue at these prices, eventually there's cannibalization, there's churn. For Apple at these levels, 100 bips of churn maybe. When it comes to iPhone, there'll be a $150, $200 price increase, but then there'll be subsidies from carriers and others. But look, now you're seeing where it's called Ramageddon, or what we're seeing in terms of memory prices. That is going to have an impact. But I view it as it's paying a small tax on the broader ecosystem that's being built out by big tech.
But if there is a little bit of a breaking point, when does it happen?
Look, I think in the next 6 to 9 months is where you need to see some sort of stabilization when it comes to prices. You need to see scale. you need to see ultimately what we're seeing in terms on the token side, where you need to see like prices start to come down. CapEx will be about $1 trillion for big tech next year, but then the monetization starts. So essentially, you start to actually now see the monetization piece, which is very important to just investors feeling like Meta, they're not just spending like 1980s rock stars for no reason.
There's one story that really caught my attention over the past couple of weeks. It's the idea of Microsoft shifting to Chinese large language models that are open source and that are cheaper. It's the idea of OpenAI pushing back their IPO, and a question of how much OpenAI and how quickly the Anthropics of the world can monetize given the cheaper competition overseas. How much do you see that as a pressure point that hasn't fully been realized or even actualized in terms of people's ideas?
Look, my view, and I think you see with OpenAI and Anthropic, the models eventually will become commoditized. And it's not just OpenAI and Anthropic. You'll have hundreds of models across the world, vertical specific. The value will be in the data, how quickly that they could penetrate enterprise. Microsoft, in terms of Nadella's seeing around the corner, understanding like you have to ultimately diversify when it comes to models, and eventually as it becomes a global sort of game. But when it comes to Anthropic and OpenAI, they understand enterprise is golden goose. That's what they're going after. Now, to some extent, part of the reason that Microsoft, that you see the stock to where it is, because there's a view like, okay, that becomes competitive. They had OpenAI, but now like where do they sit relative to enterprise? My view is on enterprise, Microsoft will continue to be the ultimate winner, but it just shows it's a convergence what's happening across the AI ecosystem.
If that's a commoditized resource, the large language models, and it really is the data providers are not OpenAI and Anthropic, well then what's the monetization prospect for some of these companies that potentially are going to IPO at $1 trillion?
Well, for them, it's all about enterprise. I mean, if you look at Anthropic's growth, it's been unlike anything we've ever seen in terms of ARR. Now for OpenAI, it's a bullseye on their back. They have to continue to monetize in the enterprise. Because enterprise, when you think about all the data centers being built and all the memory and everything, it's being built for what will be the use cases on enterprise, on the consumer. Software vendors, in my opinion, are the ones that it goes back to the second, third derivative, just like cybersecurity. So I think part of where I think investors, and I don't think it's reflected in the stocks, is like they're underestimating the scale and scope of what this is all going to look like. And I think we've talked about it. It's like party start at 9 p.m., goes to 4 a.m.,
but Dan,
about 11 p.m.
Can you monetize a model that's currently restricted?
No. And that's why when it comes to Anthropic, that's why they're starting to play nice when it comes to government. You're seeing some sort of, compromise or at least some moving of the goalposts. And that's important because Anthropic right now, I mean, you're talking about the best model in the world. You cannot be on relative to what we see on the DoD and the Pentagon. That's why it's an important time for Dario and Anthropic to get to some sort of compromise when it comes to U.S. government.
Dan Ives of Wedbush, thank you so much. Always wonderful to see you. And that is the question, ultimately. And a lot of people are asking this, Annmarie, which is essentially...
When's Fable 5 coming back?
When is Fable 5? And if it doesn't come back, how reliable is this model? And do people head over to China because it's more reliably going to be accessible since it's open source?
And at that point, for national security reasons, you can imagine the United States would not allow that. And that would become a restrictive source. But to Dan's point about playing nice, there's an information report that apparently they called Dario Amode a weirdo, and so now White House officials, and this is according to the information, White House official Anthropic is sending in their co-founder to deal with them because I think potentially a little bit more easier in terms of diplomacy between that individual and this White House.
Can't keep up with this news flow. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, President Donald Trump refusing to commit to signing a bipartisan housing bill, saying he would make a decision once he receives it. Sources telling us here at Bloomberg the legislation has been sent to the White House. The transmission starts a 10-day period, excluding Sundays, in which the president can either sign or veto it. If he takes no action, it will become law. Venezuelan opposition leader Maria Corina Machado is trying to return to her country to help with reconstruction efforts after 2 earthquakes last week. Machado says she was unable to return because the government closed its airspace in an effort to block her arrival. Morgan Stanley is cutting its oil price forecast for the second time in about 2 weeks as flows through the Strait of Hormuz return faster than expected. The firm says strong U.S. supply and weak Chinese demand raise the risk of a glut. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vani. Up next, taking back insurance hikes.
The risk here is we can't keep printing these payroll numbers without the unemployment rate coming down. All you need to do is take back the hikes that you did last year. You were buying insurance against an event that didn't really play out.
Matt Hornbach of Morgan Stanley joins us next. You're watching Bloomberg Surveillance. Good morning. Building on what might be the best 3-month gain for the S&P 500 going back to 2020. Right now, building on that this morning with a bit of a positive tilt, really led by the tech sector. That is a new development. What we're seeing is a lift of about 0.1% on the S&P and on the Russell 2000, which yesterday hit a record high. You're also seeing it build there. Right now, tier yield flat at that 4.1%. Crude coming off just a touch. Those talks may be happening in Doha between the U.S. and Iranian delegations. And watch the yen, 162. North of that, with this level really raising concerns. The weakest for the yen going back to 1986. Under surveillance this morning, taking back insurance hikes.
The risk here is we can't keep printing these payroll numbers without the unemployment rate coming down. And if that starts coming down, then both your mandates are pointing in the same direction. All you need to do is take back the hikes that you did last year. You were buying insurance against an event that didn't really play out.
Here's the latest. Investors gearing up for a slew of jobs data this week, hoping it will give them some clues about the Fed's next policy move. Matt Hornbach of Morgan Stanley writing, should these micro pressures manifest and tighten macro financial conditions, markets will place less weight on hawkish Fed tail risks. Matt, thank you so much for being with us. Just when you take a step back, what's your takeaway about whether this Fed is actually hawkish or whether they are just simply jawboning a market to do the work for them?
Well, it's probably a bit of both. We all know that half of the committee at least is leaning in the let's hike rates direction, and the other half of the committee isn't, right? So certainly it's a divided committee in a sense, but Chair Warsh brought them together during his first meeting and got a consensus vote on a pared back FOMC statement. So I do think that the data going forward, and most importantly, its implications for the economic outlook, is what will drive Fed response in action over the next 6 to 12 months.
So we've heard it from Kevin Warsh, forward guidance is dead. We've heard it from Christine Lagarde, forward guidance is dead. It seems like everyone is chucking that out. What is the data telling us? I mean, I talked to 3 economists. They'll tell me 15 different ways to look at it and different interpretations. What exactly will be the tell about whether things are heating up or cooling down?
Yeah, well, the first thing I would say is what inflation did 5 years ago should not be a relevant part of the discussion unless it was affecting inflation expectations. And it really hasn't affected inflation expectations. So I think this idea that inflation's been above target for 5 years, that's a yesterday concept. I think going forward, it will be, well, what are the implications of what we're seeing happen in the economy today, what we're seeing happen with financial conditions to the inflation outlook, not what did inflation do 4 years ago. What we're seeing in the data from our vantage point is inflation is likely to come down, much more so than it's likely to stay up here around 3%. When we're looking at what's happening with wage growth, we're looking at what's happening with productivity growth, what's happening with labor share of income, all of them point to a forward look on inflation that is much closer to 2%, if not, in some cases, even below 2%. So I would say that a forward-looking Fed, which we think this Fed will become over time, that is a Fed that's not going to be looking to raise rates. We think they'll be looking to cut rates in 2027.
But doesn't the context matter in the sense that the prior 5 years missing the inflation target continuously, doesn't that basically mean that the Fed has accepted a higher inflation?
Well, I mean, accepted it. In some ways, the Fed has had to deal with a lot of exogenous shocks that were not of its own making. And so I would say It's only relevant insofar as it has affected the inflation expectations of households in the country. And what we're seeing in the data is that it really hasn't affected the inflation expectations of households in the country, in part because real incomes have come off the boil. The real incomes over the past year did not grow very well. And it's really about income growth expectations that ends up determining people's spending habits, not what they think about inflation in the future based on what's happened in the past.
We're going to get Kevin Warsh's speech in Sintra. We're also going to get the jobs report. What are you looking forward to this week?
Well, we have the unemployment rate unchanged at 4.3%. The Chicago Fed, which releases a nowcast of the unemployment rate, also sees the unemployment rate remaining at 4.3%. I would say if that's what we end up getting on Thursday, the chance of the Fed hiking rates in July is slim to none.
Have you seen tightening financial conditions on the margins enough to alleviate concerns by some that maybe Fed conditions are a little bit overly easy in allowing an exuberance to build in markets?
It really depends on how you measure financial conditions. I mean, this is the $64,000 question. There's lots of different ways of measuring financial conditions. The San Francisco Fed produces a measure called the proxy funds rate, which looks at certain financial markets, integrates them back into the effective federal funds rate. And what that shows you is that policy has tightened by almost 100 basis points since the war began. Of course, if you look at the equity market, you're going to get a different story out of it. It really depends on what basket of financial market prices are you looking at to determine your financial conditions metric.
It sounds like you think that there's a good chance of no hikes at all and that potentially the Fed just remains on hold. Is that right?
This year, absolutely.
Okay.
We're not seeing rate hikes in the profile for this year.
So if that's the case, does this market need action to believe the rhetoric? Or are they going to say, fool me once, shame on you, fool me twice, shame on me?
Look, I mean, does it surprise anybody that the Fed is telling us that they're going to ensure inflation comes back to their 2% goal? How is that surprising to anyone? Of course, Warsh is going to double down on that message. That's one of the two main mandates of the Federal Reserve. So we weren't surprised by that, to be honest. I understand the market read it in a hawkish way, but that's just the momentum taking over. There's a lot of cognitive dissonance happening today amongst investors because look at what's happened with oil prices. Now we're just supposed to ignore the fact that oil prices have come down to a level that a month ago nobody thought, even the experts in the commodity sector, nobody thought was possible. Now we're just going to ignore that and focus on other things that happened in the past. That's not what a Kevin Warsh Federal Reserve is going to be like. They're going to look forward. They're not going to look back.
Matt Hornbach, wonderful to have you on the show. Thank you so much for being with us. Matt Hornbach of Morgan Stanley. And essentially, he was kind of maybe commenting on what the ECB officials were saying overnight in Sintra, where, you got to look at the trickle-down effects of some of the inflationary inputs.
Right. What Philip Lane is talking about is the knock-on effects when it comes to oil. But his colleagues over at Morgan Stanley also just cut their forecast for the second time in about 2 weeks when it comes to where oil prices are going. But many would say that the president blinked because he knew there was going to be an upward rise when it comes to the oil prices.
Either way, oil prices have been plummeting over the past 3 months, the biggest loss going back to 2020. Coming up next, Wei Li of BlackRock, Marc Short, former chief of staff to former VP Mike Pence, Venu Krishna of Barclays, and Bob Michael of JPMorgan. This is Bloomberg Surveillance. Good morning.
It is an uneven economy.
I don't think you get more than one hike this year.
We are in an environment where inflation is going to stay above target.
We don't know what Kevin Warsh is really thinking.
He's more the steady hand type. He'd prefer to wait and see.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance with stocks inching higher to close out the best quarter in 6 years. Chip stocks leading the pack for the quarter with a near record-setting performance. However, people now raising concerns about an overheating AI trade with the expenses mounting. And European central bankers expressing concern that the inflationary shock isn't over. Even as oil prices recede they are over the past quarter, we are looking at massive declines, the biggest quarterly decline in oil going back to 2020.
Not not quick enough, though, in terms of where oil is going in relationship to gasoline prices. The president is once again on Truth Social yesterday telling retailers need to bring prices down, and they're price gouging. The fact of the matter is, when it comes to gasoline, going to be a little bit slower in terms of how that can trickle down. When you see oil prices, they are falling, even though we had some tit for tat exchanges in terms of attacks over the weekend. Now you still have vessels going to the Strait of Hormuz. They're still talking. Morgan Stanley cutting their forecast, second time in about 2 weeks. And this is definitely going to be disinflationary. It's welcome news for sure in the United States, but as you've been saying, different story in Europe, and Philip Lane is quite concerned about the knock-on effect.
Well, here's the tension right now. It's disinflationary in certain pockets. On the other hand, consumers are still spending, and the labor market is still okay. It's not necessarily going gangbusters like 2020. So this is why JOLTS data later this morning at 10 a.m. Eastern is going to be really interesting. Heading into ISM manufacturing tomorrow, what will the prices paid component be? And then the labor market report. Is there something else that central bankers are worried about that potentially could lift inflation expectations despite the decline that we're seeing in oil?
Well, for individuals like Austin Goolsbee, he's talked about the fact that tariffs, oil, now they can really look through all of this. But services is where they are concerned about higher inflation. Of course, Thursday is going to be incredibly important. Payroll's Thursday, not Friday, it's July 4th. Did you see the range, Lisa? 25,000 to as high as 168,000. Makes me think that economists are also unsure about where this economy is going.
I think that's an understatement, and I think that they all have a dartboard and they are just blindfolded and shooting darts. Right now, what you are not shooting darts with is whether stocks will go up. Yes, they have gone up. They've gone up so much, and they continue to this morning, building on gains from earlier in the morning, near session highs now. The Nasdaq leading the charge up almost 1/3%. This, to me, really the reversal with hyperscalers front and focus. We'll be talking about that after the swoon in Microsoft was the worst for the past month, going back to 2000 actually. Russell 2000 up about 0.2%. Same with S&P. In the bond market, very quiet, although contained, and that ultimately is the story. A bid into bonds just on the margins, 4.1%, holding steady on the 2-year yield. And this, to me, really caught my eye. The Japanese yen at the weakest level going back to 1986. Will we get some sort of Treasury BOJ accord? Will we get some rhetoric coming out of the Bank of Japan to signify that maybe they're ready to hike again? Or is this okay, even though this is importing quite a bit of inflation?
We've tried verbal intervention, or maybe a verbal phone call that was trying to help in terms of verbal intervention. Will they actually move ahead with actual intervention, which we saw in 2024? And I think for this market, they need to wait and see what we get Thursday from the jobs report.
Coming up this hour, I'm so pleased to say Wei Li of BlackRock with stocks heading for the best quarter in 6 years. Marc Short, the former chief of staff to former Vice President Mike Pence, on the Supreme Court's historic rulings that came out yesterday. And Bob Michael of JPMorgan expecting the Fed to stay on hold for the remainder of the year. We begin this hour with stocks adding to gains as big tech jitters waver. Wei Li of BlackRock writing, "We seek broad AI exposure through U.S. tech, leading us to overweight U.S. equities. Even if the ultimate winners are unclear, many are likely to be found there." Wei joins us now for more. Wei, always wonderful to see you. Thank you for being here. So are you among those buying up hyperscaler stocks after the rout over the past month that have really made them some significant losers?
Well, we remain overweight the AI trade and U.S. equities. Right now, the big debate in tech and AI transformation is very much, are we in a bubble? And if you look at U.S. equity markets, the Shiller P currently is really stretched. You know, it's just shy of 40 times, which would make it 99th percentile. But if you look at forward PE, it's just above 21 times forward PE, which would make it over the last 10 years 40th percentile. So depending on kind of your assumption of earnings durability, you can come to very, very different conclusions in terms of if U.S. equity valuations are stretched or not. And for us, we think the answer to the durability question is still very much kind of wide open, right? Because there is the possibility of AI breaking out growth and sustaining earnings momentum, but at the same time, it's also possible that it doesn't happen. But we want to play the AI theme through scarcity. It's easier to kind of focus on the bottlenecks that doesn't require us to pick winners than having to pick winners. Our study shows that up until now, if we focus on scarcity and bottlenecks, we're able to get better return with less dispersion compared to if we try to pick winners, which is what we're focused on as we think about the rest of the year.
I feel like investors have been playing chase this point of scarcity, chase the choke point. Because ultimately, first it was go to the chip sector, and semi is absolutely ripped. I mean, a tremendous quarter. We're looking at some more than 40% gains on the semiconductor index in the U.S. Then people are saying, okay, well, maybe it's memory. And they're going specifically to the memory makers, and then to the energy sector. I mean, how do you sort of gauge where we are in this sort of chase for choke points?
Well, I think finding choke points and scarcity is a good strategy because it doesn't require you to, you don't need to know which model wins to know that AI is going to need chips and data centers and energy and power and great connections. And you also do not need to know which robot wins to know physical AI is going to need memories, is going to need batteries, is going to need robotics and industrial manufacturing capabilities. So we think this is a good strategy that has brought better return versus having to pick winners. And I would also note that if you look at incremental margin of some of these AI implementation strategies, they are still higher than operating margin, which means that we're still early in this AI super cycle, which is why we're broadly overweight. Whilst finding and picking winners is very, very difficult, we do think that many of them are likely going to be found in the US equity market, which is why we are overweight, but we have trimmed our overweight in emerging market equities that we have had so far this year from overweight to neutral because of the wild volatility that we have seen in parts of emerging market.
Like South Korea? Is that what you're getting at? The volatility we're seeing in Korea?
For example,
yeah.
Yes.
So when it comes to this idea of scarcity, you write in the note, scarcity, does that lead to abundance?
So our media outlook is very much framed around this big tension, which is scarcity versus abundance. And our view is that AI is currently creating greater pressure in near-term scarcity, but then opening the door to potential abundance in the future. The biggest macro question at this point is if we're able to break out from the 150-year-old growth trend of around 2% into something higher. Right now, external forecast actually points to that we are able to break it out. It has never been done before, but hope and expectations are pointing there. And correspondingly, there are big kind of unavoidable macro questions along the lines of the cost of AI, along the lines of rate, along the lines of inflation. And that very much has conflicting narratives on both sides of scarcity versus abundance. But the bottom line is, we don't need to bet everything on trying to predict the answers to this question. It's impossible to do that with high conviction. We rather build portfolios around high conviction themes that are likely to be resilient across all the scenarios. And right now that lands on us being still risk on.
We just had this technology conversation with Dan Ives, and we talked about demand destruction. Is that part of the narrative as you look at scarcity to abundance? Do you have to get to that point of demand destruction?
You mean demand destruction if the cost of AI goes higher?
Yes,
and potentially. Oh, okay, I see. Well, well, as we think about kind of AI transformation, there are three constraints that can potentially accelerate it or curtail it. One is a physical constraint, and the cost consideration is part of it. One is financial constraint, for example, the immense amount of debt issuance and now IPO coming down the pipeline. And one is social political constraint. Here we're talking about NIMBYism and all of that. Right now, I would say physical constraint is binding somewhat, but not to crazy levels. Financial constraint is starting to tense up because the starting point is very healthy, but we're seeing more issuance down the pipeline. Social political constraint is also likely going to accelerate as we head into midterm, for example. So they're starting to bind, but the demand destruction right now, I think it's still too early to say because everyone is in it, in this arms race, and they're throwing everything at it. And demand destruction as part of scarcity versus abundance is one of the big questions that have yet to be answered. But again, if we were to bet on bottlenecks and scarcity, we do not need to answer that question to be able to build a high conviction portfolio, which is what we're doing.
I find it interesting that you've trimmed some of the emerging markets exposure. South Korea, of course, the volatility there. How much does this have to do with something structural in terms of just the volatility in markets and the valuations? And how much does this have to do with a dollar that seems to be resurgent, that potentially could upend a lot of where people were overweight heading into this year?
What is really interesting is that so far this year, as we held onto our emerging market equity overweight, that has happened, the outperformance of emerging market versus developed market equities has happened alongside resilient dollar. So point being, emerging market is no longer just a proxy play to global risk, to dollar. I think there are some fundamental kind of drivers within the emerging markets themselves that are actually creating return dispersion beyond the external financing conditions and dollar strength. And our view is that dollar can hold up and emerging markets can hold up at the same time. And emerging markets are very much actually driven by mega forces along the lines of AI ecosystem, aging population, and geopolitical fragmentation.
HSBC came out and said, HSBC said that an explosive dollar rally is among the biggest pain trades this year. And I wonder how much they have Japan in their view, because what we're seeing overnight, definitely testing the Bank of Japan and policy in general. How do you sort of see that? I mean, is this something you just stay away from? It's radioactive? Or do you say, you know, this is something that you want to play given how big this dislocation is?
We have a low conviction neutral view on the dollar.
How much can you say we have absolutely no conviction?
It's really hard to have high conviction currency view, period. But I would just remind everyone that even just 1 year ago, right, as we look at some of the tariff-related volatilities and you know, like there were talks of the demise of the dollar, and it was such a kind of big thing. De-dollarization was such a big theme. We were pushing against it because the prominence of the dollar in global financial system is not going to change, you know, like from one day to the next. So, and lo and behold, dollar actually strengthened the last few quarters. So I think narratives can run wildly, especially on something like the dollar. But looking at fundamentals, you know, like we think dollar is driven by real rate differentials, is driven by kind of risk appetite, perception of U.S. risk premium. We actually think that dollar doesn't need to kind of go lower from here. We have a neutral view right now.
Wei Li, thank you so much for being with us. Wei Li of BlackRock here in the studio. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. The U.S. House Committee opening an investigation into drug makers Merck and AbbVie. Reuters reporting lawmakers are looking into potential involvement in clinical trials conducted in China that may have helped fuel the country's military capability. Supermicro's offices in Taiwan raided by government authorities. Sources telling us here at Bloomberg the move widens an investigation into the alleged smuggling of Nvidia chips into China using the company's servers. Despite being one of 23 underwriters, South Korea's Mirai Asset Securities received no stock allocation in SpaceX's IPO. Sources telling us here at Bloomberg it was due to a misunderstanding over how orders were supposed to be submitted. The company is apologizing to clients and being inspected by local regulators. That is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, expanding the president's powers.
Should we expect more firings as a result of this ruling?
I don't think so. It gives me the right, and not me, it gives a president the right to do what the president should have the right to do.
Marc Short, former chief of staff to former Vice President Mike Pence, joins next. So this is Bloomberg Surveillance. Good morning. Seeing another lift after already what could be the best quarter going back to 2020. Right now, as the session goes on, near session highs, up 0.2% on S&P futures. Big tech getting another reprieve after seeing a real hit to hyperscalers over the past couple of months. Now you're seeing a rebound over the past two trading sessions. 10-year yields lower, just 4.37%. Crude continuing its descent. I mean, we have just seen a massive sell-off, the biggest going back to 2020, as some of the tensions cool in the Middle East. and the Japanese yen. Watch this space squarely through that 162 red line. What's the new red line? How does the Bank of Japan respond to the weakest yen going back to 1986? Under surveillance this morning, expanding the president's powers.
Should we expect more firings as a result of this ruling?
I don't think so. It gives me the right, and not me, it gives a president the right to do what the president should have the right to do. And the president has the right to do this, and that has to do with a lot of agencies all throughout the system.
Here's the latest. The Supreme Court giving President Donald Trump the authority to fire the heads of roughly 24 independent agencies at will. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, what's the latest?
Hey, Lisa. Well, this was a pair of blockbuster rulings yesterday by the Supreme Court, one of which expands the president's power to remove officials at independent agencies for any reason. It overturns a 91-year-old legal precedent designed to shield these officials from political firings. But the court essentially found that if these agencies wield executive power, they should be accountable to the chief executive. But importantly, the Supreme Court did issue a limited carve-out for the Federal Reserve, ruling in a separate case that Fed Governor Lisa Cook can keep her job for now. It's a decision that bolsters the central bank's independence. And I have to say, the Chief Justice John Roberts made it pretty clear that the majority felt that there was something larger at stake here beyond Cook's job, writing in part, quote, that monetary policy should not be subject to political interference. Now, the court faulted President Trump for not giving Cook enough notice or a chance to defend herself against allegations of mortgage fraud. We should say that Cook denies any wrongdoing. But importantly, the Supreme Court stopped short of saying whether the allegations, if true, would amount to sufficient grounds to remove Cook from her position. And Lisa, that means that this case could end up in front of the Supreme Court again, because now the legal issue of whether or not there was sufficient cause to remove Cook from her job or try to remove her from her job now needs to make its way through the lower courts.
Tyler Kendall, thank you so much for that. Marc Short, who formerly headed up the staff for former Vice President Mike Pence, writing, the legislative branch has created multiple government agencies that they have deemed are independent, but they have to be accountable to somebody, and that somebody is the duly elected president. Marc joins us now for more. And Marc, this is something that a lot of people have been talking about, right? That the Supreme Court had been moving toward this ruling for a while. How important do you think this is to the tenure of President Trump in terms of what he plans to do in the near term?
Lisa, I think it's more important to just future presidents, honestly, more so than President Trump. I think the reality is that this has been something that's been growing for many years, is the giant bureaucratic state. And I think people might look at it and say, well, you know, so what? What is it? Congress can pass laws and create agencies. But our founders intended to be one executive, not to have 535 additional executives in the legislative branch telling you who you can hire and who you can't. And so they can pass laws, they can create new agencies, but they can't tie the hand of the executive branch and tell them who you can actually staff and not staff there. And I think this is the right ruling from the court. And I think the court also, though, in the Lisa Cook ruling was clear to say this is not universal because our founders created a central bank. Alexander Hamilton wanted a national bank, and so there's limitations on this when they wanted independent. But for all these agencies, whether it's FTC in this case or CFPB, you can't have Congress just going creating these and tying the hands of the executive branch and telling them you don't have control over actually who runs these departments.
Is it, though, degrading the checks and balances we have in terms of on the executive branch? By now, this is giving the president more power than we've ever had in modern day history.
I don't know if it's giving him more power, Henry. I think it's what the founders intended, to be honest with you. And I think there are checks and balances with what the legislative branch can do. There are checks and balances with what our elections can do. And so naturally, people say, well, does that mean you'll have changes in these personnel every 4 or 8 years? Well, maybe so, but that's what the American people get to decide. They get to decide by changing the executive branch who they want to be running these agencies.
How do you see the Lisa Cook playing out now, that situation? Because she's going to fight this in lower courts. I imagine the administration will as well.
I don't know if they will, Annmarie. I think this was always a politically charged investigation by the administration. I think there was a double standard where there are actually people in his own cabinet that have also listed other mortgages as their primary residence. And so this was clearly a double standard where he was trying to go after Jerome Powell and change the influence of the Fed. Now that he has his own person and Kevin Warsh there, I'm not convinced they're actually going to continue to pursue this. I think that this is he wanted to do this to apply pressure to Jerome Powell. I think he was less concerned, honestly, about the mortgage fraud, or else he would have taken care of people in his own cabinet who had the same issue.
So when it comes to then Lisa Cook, she stays. what does that mean for Jerome Powell? Does he just continuously get the jawboning from this president, or do you think that he would view this as?
I don't know how much he gets jawbone anymore. I think that's going to fall on Kevin Warsh, and I think that Powell probably should stay because even though they've dropped the initial investigation, they haven't said that that's going to be permanent. And so I think he'll probably stay throughout the rest of his term.
I want to talk a little bit about the tensions that have been building between the Republican congressman and President Trump. And we've heard anecdotes about screaming matches and what was it, Matt, as a murder hornet over in the Oval Office as they discuss some of the issues. We've seen it erupt over the housing bill that was passed through to take a vote. How do you see this evolving? I mean, is this normal or is this a different kind of break, especially after the midterm elections that we just saw?
It's not normal, but I also think that there's this perception that the president is as invested in the midterm results as they are, and he's not, Lisa. I don't think he really cares. He's not as invested in what happens. And we can say, well, that's silly because maybe he'll get impeached again. But from the president's perspective, he feels like I've survived multiple impeachments. I think he feels he can do most of what he wants without Congress. He passed the one big, beautiful bill. Has there been an articulation of what a legislative agenda is beyond that? I don't think there really is. And I think the president actually enjoys having an adversary, whether not to be Jeffries or potentially Schumer, whoever Democrats select to lead them in the Senate. And so I think for him, a lot of this is like, I don't really care what's happening in Congress.
Does it make sense to you that one of the adversaries seems to be gasoline retailers right now?
That is very weird. And I think that this is a play that would typically be used by Elizabeth Warren and the left to go after price gouging and use DOJ to target private sector companies. But we have seen a continual shift from this administration to embracing more Elizabeth Warren policies, whether or not it's the original housing bill or it's applauding the government trying to take ownership in private sector companies. And so it's one more stretch where this administration wants to use the levers of government to involve itself in the economy as opposed to a traditional Republican administration wanting to advance free markets and have a hands-off approach.
Well, who is going to advance that right now? Because as you just said, both sides, both tails of both parties are coming around to the same place. Where is the center at a time when we've got, preliminary elections, you've got the primary elections that tend to more heavily favor some of the people on the extreme tails? I mean, how do you see that developing heading into what we see this fall?
I think that there's a lot of Republican legislators who are uncomfortable with it but are afraid to speak out because they don't want President Trump to interfere in their primaries. But I think it's tragic that right now there is not really a voice for free markets inside our Congress, inside our Republican Party, the way there always traditionally has been.
Marc Short, thank you so much for being with us today.
Thanks for having me.
Marc Short, who formerly led up the staff for former Vice President Michael Pence. Ultimately, this was something we've talked about a lot of times, whether it's taking stakes in companies or whether it's talking about potentially levying some restraints on gasoline retailers or even the big oil.
Capping credit card interest rates. At one point earlier this year, the president called Senator Elizabeth Warren to talk about that and talk about affordability. I asked him once, is it odd? Does it feel weird? Is it awkward that you were lining up behind Senator Bernie Sanders? And the president said on some economic issues, they agree.
Guess what? Markets don't care. Right now, they just see the AI trade and they see all sorts of dynamism, and they're upgrading their expectations. Coming up, Venu Krishna of Barclays raising his year-end price target for the S&P 500. Plus, Yahir Anand will be joining us again. Super micro rising on memory demand. This is Bloomberg Surveillance. Good morning. Futures looking at near record highs of the day as people look toward a potential best quarterly return going back to 2020, up about 0.3% on the NASDAQ, leading the charge after really taking a beating in terms of the hyperscalers in particular. S&P futures up 0.2%. Russell 2000 underperforming today, outperforming over the past quarter. If you take a look at the why, in part it's because of the dynamism in the U.S. economy. It's not because you're necessarily going to see an accommodative Fed. In fact, you've seen yields rise more than 30 basis points at the front end of the yield curve over the past 3 months. Right now, 4.11%, just an inflection upward as the session grows older, but pretty calm. I mean, it really has been calm, despite some of the action that we're hearing overseas in Sintra and this discussion about inflation and how it could be sticky. Bond markets are kind of yawning and moving on.
Well, certainly, especially in the United States, because oil prices are coming down in the United States. Europe, of course, is going to be a little bit more vulnerable, and that's why Philip Lane is talking about these knock-on effects. Also, the fact that the consumer wants to see that this memorandum of understanding, this peace that's very fragile right now between Iran and the United States, actually is sustainable. Because right now, do the consumers in Europe really believe that? Especially when you look at what's going on in Europe, with an incredible heat wave. People don't have air condition. It's pretty dire there at the moment.
I like what Matt Hornbach had to say. It's like people are pretending that oil prices didn't go down as much as they have over the past 3 months and are simply saying, look, there are other levels that are going to increase, potentially commensurate with the labor market. 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Super Micro. The stock is largely shrugging off that news that Taiwanese authorities raided the company's offices. Of course, all that tied to the alleged smuggling of Nvidia's AI chips into China using Super Micro's servers. The company says it is cooperating with investigators, but as you can see, the tech trade is back in action today, so shares are shrugging that off, up 1.3% in the pre-market. Meanwhile, Aero Environment, this is a defense company. Shares are soaring, now up more than 30% in the pre-market after the drone and defense technology company beat expectations and issued a better sales outlook than expected. They're saying that demand for their drones and counter-drone technology are soaring as governments continue to ramp up spending in defense. And we end on Jack in the Box after Wendy's remarkable rally last week, and now this fast food name is on the move. Shares are up 8.4% after it refinanced $500 million in debt. I will also note that, like Wendy's, the stock is heavily shorted with short interest at nearly 38% of the floats, which could also be contributing to this rally. Lisa.
Thank you so much, Yahira. So evidently Wendy's and Jack in the Box could be the new GameStop. Is that what we're talking about here?
I don't understand. It doesn't make sense to me.
Well, either way,
How can they be meme stock?
Good burgers, and it is
And
summer,
Frosties.
so there you go. I mean, if you're out west, check it out. If you're a European tourist, something you can trade. What's the
Freddie
can go to a Jack in the Box. On our radar this morning, peace talks between the U.S. and Iran expected to continue today in Doha.
We'll see how that goes, but we're doing very well on that front. But the meeting in Doha is going to be perhaps important, perhaps not. We're going to find out.
Tehran reiterating it wants full control of the Strait of Hormuz. An Iranian diplomat sharing the country aims to work out an agreement with Oman to oversee ships passing through the waterway. Susquehanna suing 100 John Doe defendants in an attempt to unmask the perpetrators behind an insider trading scheme. The firm claiming individuals made at least $100 million on insider information about a Chinese government crackdown on cross-border brokerages. And of course, they were on the wrong side of the trade, which is why they are seeking litigation. And the SpaceX IPO leaving one of South Korea's biggest brokerage firms empty-handed. A miscommunication at Murray Asset Securities leading to more than $1 billion worth of Korean demand not being entered properly. The firm receiving none of the intended shares of the mega IPO, even though it was selected as one of the underwriters, one of the few foreign underwriters for this deal.
Unbelievable. And you can imagine someone or some people are going to get fired. It sounds like where the miscommunication was that they went around trying to get some indication for investor demand, but that was never translated into actual order books and these actual bids. So in the end, they were left with nothing when it came to the IPO after all this work was done at this South Korean firm.
Yeah, and they talked about how they bow their heads in shame to their customers. A lot of questions there, and I'm sure that there will be more opportunities for food fights with some of the other IPOs coming down the pike. Turning back to markets, the S&P 500 on track for its best quarter in 6 years. Venu Krishna of Barclays raising his year-end price target to 7,800, writing the equity bull case remains intact, but earnings and AI capex visibility must do more of the work as Fed support fades and positioning is less able to absorb disappointment. Venu joins us now. Venu, great to see you. Thank you for being here. Why just 7,800? Why not 8,150 like Lori Calvasino over at RBC?
Yeah, I mean, we can nickel and dime about the number. But I think the question is what is driving the price target upwards further?
Okay.
So, and I would say that, earnings are clearly so strong. We go from 321 to 337. That's 21% increase. We are shade behind consensus now. But I think we are more conservative on the multiples we're willing to pay, recognizing that compared to 3 months ago when we upgraded our outlook quite significantly in the middle of the crisis, the macro risks actually have, on the margin, increased. And so it's better to be more cautious. For example, the rates outlook has changed. We have a new Fed. The AI story is still intact, but the scale of spending is significant and at a scale where there is some apprehension about the ability to monetize it, fund it. So I think when you take all that consideration, we say, we want to be a little bit more careful about the multiples we're paying for the market and let earnings do the job. And the earnings visibility this year, next year is pretty robust.
There's a lot to unpack here, and you should get a victory lap. Every time you come on, Barclays gets a victory lap for calling and raising your outlook in the middle of a war when everybody else was cutting their outlooks, and you're right. Now you're getting more cautious because of macroeconomic potential issues, even though the war in Iran seems to have settled into an uncomfortable, uneasy sort of situation that at least has brought oil prices lower. Yeah. What potentially could drive the Fed to tighten if oil prices are lower, if potentially you still do have some pressure on that side, but not as much, and you aren't necessarily getting any holdback when it comes to the investment? I mean, why aren't you sort of discounting that hawkish reaction function a little bit more?
So first and foremost, let's start with at the macro level. The inflation picture has gone the wrong way, right? And so on the margin, we are still below in the 3% range, which is not dangerous. But equities already are in that territory of negative correlation between rates, 10-year rates, and equities. And our empirical work has shown that the 5% threshold is important. Luckily, we are a good 75 basis points roughly away from that. But the closer you come to 4.5%, that becomes an issue.
On the 10-year.
On the 10-year. And right now, inflation is not just sticky, but interestingly, the very phenomenon of AI, CapEx, and spending, and earnings, driving earnings, is also feeding into core PCE inflation because of the increase in memory, because of the increase in chips, because of the increase of components. The list goes on. So I think, in the short term, this AI cycle, as strong as it is actually feeding into inflation. And at the same time, the Fed is at a situation where we're no longer talking about rate cuts. We're talking about the best case is if you stay flat for a longer period of time, and most likely have fewer increases than potentially what could happen. So I think all that changes dynamics. And when we look at our fair value model for what we think we want to pay for S&P, this outside of tech, that number has come down, right? And if I look at big tech, they're posting phenomenal earnings, 30% in Q1. The rest of tech outside big tech, 50% earnings. But for big tech, for example, multiples have come down. I like that combination. I would rather they keep pushing the earnings, the multiples slowly coming down, because the scale of spending is simply enormous. And we need to get some sense of when that starts stabilizing and tapering. We are not there yet. In fact, our fundamental analysts have bumped up their expectations yet again in 6 weeks for AI CapEx recently. And now we're talking about roughly 1.2 trillion in 2028, almost 250 billion more than where the consensus sits. So that's the reality.
Well, we had your colleague on yesterday who was saying how it's uncomfortable but has to upgrade because of what is going on in earnings. But if the Fed were to hike, would you have to decrease your price target?
No, listen, the question is, why are earning rates going up, right? There's a sweet spot based on the work we have done where rates can go up, but equities can also go up, which means nominal earnings are strong and the growth is contained. The Fed is vigilant and in control. But there always comes a tipping point where the risk of either inflation is very high when the rates are going up, or the reverse case and the rates, risk of deflation picks up. So I think we have been in that sweet spot. But now there's again some queasiness about the fact that we won the initial battle, the big battle of inflation coming down from 9% to the low 2.5%. Now we're again inching back to the roughly 3% range. In this territory, that is inflation being 3% and below, the negative correlation kicks in at the 5% level for 10-year. That's empirically.
But if it's AI-driven inflation, the Fed hikes rates, is it even to say that that tool is going to help in terms of the AI inflation, or is it just going to hurt other parts of the market?
No, because ultimately equities are long duration instruments, and what is driving the market tech is especially long duration, given the AI story right now, where there is a lot of uncertainty as to when those productivity jumps will really kick in, and ultimately who is the winner and loser in terms of how it plays out. So in all that uncertainty, rates have less to do with just the impact on economic growth, but more to do with just the multiples you're willing to pay for the scale of uncertainty you're dealing with. But luckily, the spenders are posting very good numbers, are actually adopting AI in their own business models. And so that combination is something we're comfortable with. That's the reason why we continue to like big tech. I mean, if you look at the correlations between big tech itself, it's collapsed, which means that dispersion is very high. So we think either you own that basket as a safe way to play the market, or better still, you enter the derivative space and do something which takes advantage of a potential increase in dispersion, even within that small group of stocks.
Do you think the multiples have come down on the hyperscalers enough to make them more attractive than, say, some of the chip players?
When I talk about big tech, whether it's a combination of 4 hyperscalers and Apple and Nvidia, right? We may have to change the definition, now that you already have SpaceX, but that's for another day. But for big tech, the multiples have come down to about 24 times. We were at 28 times at the start of the year. The bottom, which we have tested multiple times in the last 4 years, is around 21 times, right? So I think 3 to 4 handles lower, with earnings printing still 30%. Beats continuing to be still pretty significant. That's a setup, I think, which we like. And the only uncertainty is the level of CapEx spending. So let's wait and see what happens.
Venu, Krishna, thank you so much for being with us. Always wonderful to see you. Venu, Krishna there of Barclays, expecting 7,800, which sounds like an upgrade, but when you compare it to everything else, it looks like, well, why not 8,200 like some of the bulls?
Well, when I looked at the note, I said, oh, this actually feels a little bit muted for Venu, because when you look at it compared to everyone else, actually, it is, but they got the call right at the height of the conflict. So,
and there definitely is muted expectations, especially heading into 2026, 2027, and 2028. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vani Quinn. Vani.
Lisa, thank you. Rocket Lab is buying satellite operator Iridium in an $8 billion cash and stock deal. The acquisition combines Rocket Lab's launch and satellite-making businesses with Iridium's low Earth orbit network and spectrum assets. The Trump administration is tightening federal student loan rules. The Wall Street Journal reporting that colleges that don't meet new graduate earnings thresholds will lose access to federal loan funding, with about 3,200 programs currently on track to fall short. A dangerous heat wave is spreading across much of the United States this week. Forecasters say temperatures could reach the 90s and low 100s across large parts of the country, with many places expected to challenge or break daily records. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vani. Up next, betting on a cut.
So I would say that a forward-looking Fed, which we think this Fed will become over time, that is a Fed that's not going to be looking to raise rates. We think they'll be looking to cut rates in 2027.
Bob Michael of JPMorgan Asset Management joins next. From New York, this is Bloomberg Surveillance. Seeing a lift right now under the market, building on what could be the best quarter going back to 2020. Right now, you're seeing that gain led by the tech sector. You're seeing a more than a 1/3% gain on NASDAQ futures. A lower gain, actually, on the Russell 2000, lagging behind after outperforming over the past couple of sessions, up 0.1% in the bond space. This is interesting. We've seen a little bit of an inflection upward, although really barely. The calm in bond markets, despite the volatility and rhetoric, has been remarkable. Although we are eking higher, breaking through that 4.12% on 2-year yields, up more than 30 basis points on the quarter. And a real question here, how much can the Fed remain on hold? How much are they going to hike? Could they even potentially have a chance to cut? Under surveillance this morning, betting on a cut.
The data going forward and its implications for the economic outlook is what will drive Fed response in action over the next 6 to 12 months. I would say that a forward-looking Fed, which we think this Fed will become over time. That is a Fed that's not going to be looking to raise rates. We think they'll be looking to cut rates in 2027.
Here's the latest. Investors bracing for a slew of economic data due out this week, looking for a signal on the Fed's next move. Bob Michael of JPMorgan Asset Management expecting the Fed to hold rates steady into year-end, writing, "We're watching both improvement in inflation from reduced energy prices and potential tightness in the labor market as CapEx spending accelerates." That sort of two-pronged risk that keeps them on hold. Bob joins us now, which is wonderful, always for us to get to see you. A real question here about how much your views shifted after the last FOMC meeting and in the face of some of the rhetoric that we've heard from other Fed officials in the past week.
After the last FOMC meeting, our thinking didn't shift all that much. We thought that the Fed's bias towards easing going into the meeting was outdated. We saw a lot of CapEx underway, not only in the U.S., but globally. You can't name a sovereign that's not interested in investing in energy security, in defense of its borders, in AI. And those are multi-trillion-dollar spends for any economy, any in the world. So that will be a nice tailwind to the global economy.
What's fascinating, since the FOMC meeting, what you've seen as people increase the chance of a rate hike and actually bid into the long end of the yield curve. They've seen this as a positive for duration. Do you see it the same way based on all of that CapEx that you just talked about?
Near term, a Fed that has tilted hawkishly, and I think that's a fair assumption, even though we don't think they'll hike rates this year, should create some stability for the long end. It should allow long duration buyers, insurance company, pension funds, to come in and hunt around for cheap bonds. It could be some of the corporate debt that's coming out of the hyperscalers. We've seen some of that. But over time, does it hold? Probably not if we're right and you see this acceleration in growth, if you see the war in the Middle East in the rearview mirror, and oil doesn't need to go back down to 60, somewhere around 70, that should also be a bit of a tailwind to the global economy.
But some members of the Fed are concerned about inflation in services. That has nothing to do with what's going on in oil prices.
No, services are going to be a hard one. We're going to see that in the labor data on Thursday because everyone's looking at leisure, hospitality, and transportation. Well, if you think about the World Cup, those are the three things where you're going to see a lot of hiring: leisure, hospitality, and transportation to get to the matches, particularly if you're coming from overseas. I don't know if it's going to be that temporary. It just feels like there's a broader acceleration underway in the U.S.
If you feel like this Fed is hawkish, Kevin Warsh is hawkish, but there's not going to be any sort of hike this year, does he need to deliver? Lisa made this point earlier. If you want to set deterrence, don't you need to act on it so people believe that it's real?
Yeah, I think that's Lagarde's mantra is, what's the point of having a reaction function if you don't react? Well, we don't know what his reaction function is. Maybe he'll detail some of that in Sintra. When you roll out 5 task forces that report back by year end, you're pretty much saying you're going to glide into year end and only move things if something dramatic happens. I don't know that anything dramatic will happen between now and year end.
We were talking with Matt Hornbach earlier. We were just playing that clip from Morgan Stanley, who said that he thinks the Fed will remain on hold. Similar call to you, but then that the Fed's going to cut in 2027. Do you think that's the path of travel? Because based on what you're saying with the reacceleration of the U.S. economy, less clear.
That's not what we're expecting. We're expecting that these underlying trends in growth, that the amount of money sloshing around the system, all the CapEx that's going on in the U.S. and globally will start to accelerate growth and inflation pressures, and the Fed will have to come back in next year and hike rates once or twice. This is not a dramatic hiking cycle like what we saw going into 2022, into 2023. This is more maintenance hikes. Other central banks are doing it. They've got some cover. Who knows what the task forces will come back with? They may get some cover from that. But for us, the balance of risks, even though the Fed doesn't talk about them anymore, is to the upside in the economy, not to the downside.
It feels like this is a sea change right now underway. And we heard that with Christine Lagarde leaning into getting rid of forward guidance also. It's not just a Kevin Warsh issue at the Federal Reserve, speaking overnight in Sintra, talking about that. I just wonder how you would frame this moment? Because it seems like, and you've talked about this before, more volatility in inflation, higher yields, a bit more chop, a bit higher defaults. I mean, how different is it to be a central banker in this moment navigating through what we're seeing right now?
It's gotten increasingly complicated. I think when they look back at the last 3 years and see how well the global economy has done through a rate shock, the Fed raised rates 525 basis points. You broke the regional banking system. You had Liberation Day and tariffs. You had an oil shock. And yet the economy has done fine. They've had to go back and reassess their own frameworks. Maybe there's just more policy response that they're not accounting for. So I understand the tendency is to say, hey, we haven't exactly gotten it right. Maybe we should pull back with less forward rate guidance, less, sort of framework around what we're doing until we revise it. I just think that's wrong. I don't know how less transparency, which leads to less accountability, is the right thing for public institutions to do. I don't know how that's better for the markets or for market participants. I'm for more transparency. I'm on here. You're asking me a lot of things. I don't expect to be completely right on everything, but we're investing a lot of money. Our investors have a right to know what our decision-making framework is and the transparency around it. I don't like that the central banks want to roll that back. I do accept that no one operating model is the only right model. You can have multiple operating models work, and we've seen that in the past with the Fed. I just liked the transparency better.
What's the market response to less transparency? Is there a consequence to it?
Well, the market response is there's going to be more opportunity. And as an active manager, maybe that's what I should like, is that there will be more volatility. It will be uncertain what central banks are focused on. In the absence of central banks creating a narrative, we'll all make up our own, and we'll all choose the data which supports that. So, yeah, for me as an active manager, that's great. But I step back and say, is that really good for market participants? I don't think so.
Always wonderful to have you on the show. Bob Michael of JPMorgan Asset Management here with us. And this really ultimately is what a lot of people are dealing with. It might kind of feel bad from a theoretical perspective. At the same time, if you can make up your own theory and potentially be right, well, that's what people are going to be focused on.
If you're right. He's preaching to the choir here. I think as journalists as well, we want as much information as possible. Whether that is a lacking of a dot or lacking of forward guidance in terms of communication. We're hoping we get maybe a little more clarity from Kevin Warsh and Sintra.
We will be getting more clarity coming up from Kevin Gordon of Charles Schwab, who will be joining us, as well as Rebecca Babin of CIBC, Lauren Saidel-Baker of ITR Economics, and David Rubenstein of the Carlyle Group. All of that coming up next. This is Bloomberg Surveillance. Good morning.
There's a bit of a schizophrenia here about what actually is the path to a peaceful place for the market.
There's finally an awakening to this shift in focus away from those early players of the AI trade.
There's likely to be a broadening of the market.
You get nervous at one point on the AI trade every single year, apparently.
There's just a lot of fragileness in the market, but the overall sentiment, I think people are still pretty bullish.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to the third hour of Bloomberg Surveillance. Futures near session highs, building on the best quarter for the S&P going back to 2020. The tit for tat in the Middle East continues, but markets are barely paying attention since oil prices have fallen, and they continued to fall earlier. Now they're just ticking up a little bit, but still the biggest decline for a quarter going back to 2020. Instead, though, the attention is turning to jobs. Jobs data later this morning with JOLTS and then ISM manufacturing tomorrow. Watch the prices paid. At a certain point, if this is a data-dependent central banking world, we are all, Annmarie, focused on the data.
Absolutely. And the jobs report is going to be important this week, of course, is the labor market continuously going to hold through. And what does that mean in terms of how does the Federal Reserve view the economy right now? As they're really divided in terms of inflation. Yes, they can look through oil prices now. The market has completely moved on from the Strait of Hormuz. They moved on from tariffs. But as Bob Michael and others have been talking about, what happens in terms of services, is that going to be harder? It's a bit more sticky.
And we're going to be hearing from Kevin Warsh tomorrow, which actually should be a really important moment if he explains what he has, who he is, what his ideology is, and how it might have changed since 2011. Of course, we also are tracking a slew of earnings. Nike comes out after the bell. And a real question here about whether you start to see a broadening out. Nike's a turnaround story in particular, but as we head into the next earnings, whether we see a broadening out in terms of profitability outside of big tech and whether that rotation can continue to take hold.
And can it continue if you truly believe the Federal Reserve is going to hike interest rates, or potentially is this just verbal rhetoric to make sure they're tamping down inflation expectations? When it comes to earnings writ large, though, what have we continuously heard from strategist after strategist? We are going to lift our S&P 500 targets because of earnings. Goldman was talking about a 22% increase. That's not just the AI trade, also big energy companies.
Yeah, and what you have seen is a real dispersion that has continued, and frankly, an outperformance that has been tremendous for the equal weight S&P. This morning, big tech taking back the mantle of the outperformer, as you do see the Nasdaq up about 1/3%, S&P futures off the session highs, up about 0.1%, and you can see Russell 2000 turning negative in tandem with this. 2s, 10s, and 30s. You are seeing a bit of a lift in yields after earlier having been lower, continuing to lift throughout the session. 2-year yields climbing now steadily above 4.12%. And in the fixed income and the currency space, a real question here about what a stronger dollar will do around the world. Japanese yen at the weakest level going back to 1986. A question about red lines, a question about whether the Bank of Japan has the ammunition, the will to raise rates. Coming up this hour, Kevin Gordon of Charles Schwab with stocks holding steady. Rebecca Babin of CIBC on the hidden risks oil markets are overlooking. And Lauren Saidel-Baker of ITR Economics on why hiring should pick up across the U.S. economy. We begin this hour with stocks just inching higher after a stretch of volatility, on course for their best quarter since 2020. Kevin Gordon of Charles Schwab writing, "It's time to come up with the new acronyms that capture the two most powerful market forces today. The muses versus the ammo. The muses, memory names, who have dominated with the hyperscalers, ammo lagging. Their firepower is revealing itself given the drag it's exerting on the S&P 500 performance, effectively keeping us in a duck market." So you have Muse, you've got ammo, you've got ducks. Explain yourself.
There's a lot going on. Well, I think that, this is kind of a way to correct for what has become, I just think, this fragmented story, specifically within the Magnificent Seven. And this is something that we've been talking to you guys about, writing about for a couple of years now. Something that really started in 2024, end of 24 into 25, where you are just seeing a more fragmented and more dispersed environment in terms of returns among the Magnificent Seven. So I think grouping it now, especially with the phase of sort of this AI cycle that we're in, having different groupings for them with specifically the hyperscaler group, but then specifically within memory, just because of how sharp some of those performance divergences have been. And then you even, I think, add a third group, which just is the semiconductor group, at large. You have all three of those different groupings exerting different influences on the market, and I think last week is sort of a perfect example of this. Every single day last week, the S&P 500 at the index level fell, but breadth was net positive. So you had more members advancing versus declining, and that's kind of an example of this duck market where you can bring it back to even earlier this year, pre-Iran conflict. You had a lot of that activity where it didn't look like the index was doing much, but there was this sort of healthy activity under the surface. So it's another way, I think, to look, especially if the ammo group, if the hyperscalers are going to pull back a little bit or not participate as much, which has been the case over the past year, then you probably don't have as strong of an index gain, but you could have still strong activity under the surface.
There's a theme under the divergence that we've seen between the muse and the ammo, I'm going to get this right, that we've seen over the past week, which is an increasing anxiety about how much money the hyperscalers are spending on the semiconductors and whether the profits are going to justify it in the near term to allow some of their shareholders to continue to stick with them. Do you think that stresses the story on both sides, right? So on one hand, you've got the hyperscalers getting punished. Does that restrain some of the capex that could be helping potentially down the road in the semis?
I think it does. But this is also not a news story. I think if you back this up, past few years, you've gone through these ruptures and these periods, especially for a sector. If you want to keep it sector specific, take U.S. tech, or even if you want to look at something like the NASDAQ 100. much bigger corrective phases at times when the rest of the market hasn't gone through that. I mean, the fall of 23 is kind of an example. The summer of 24 is an example. Early 2025, not related to specifically Liberation Day, but there have been these sort of rolling periods associated with earnings season in particular. I heard somebody at one point call it CapEx season. Now it's not earnings season anymore. And last October was sort of the perfect example of that, where you had a lot of pushback from the broader investor base, specifically the retail investor cohort, which I do find interesting, which has kind of taken a step back in this latest leg up over the past 6 to 8 months. That cohort has sort of taken a step back, I think somewhat related to some of the skittishness around, the worries around some of that CapEx spend and how much it has been upped, how much the forecasts have been upped over time.
This is also a divergence of this because it's around the world. It's different, right? Your muses are linked heavily to what's going on in South Korea.
Absolutely.
Yeah, so how do you think about that in terms of where you invest if it's everyone wants to go all in on the United States, but you are seeing these gains around the world?
Well, I think there's sort of two aspects to that. Number one, the idea and the notion that anything related to the AI trade or living in that theme or that ecosystem is not going to be automatically biased towards the U.S. I think, of course, the U.S. still captures a lot of that upside, but some of these more extreme moves have been within, as you mentioned, the South Korean stock market. And it's another way, I think, for us to also, maybe this works in the benefit of the United States, what we try to reinforce to investors, especially when I get the question at numerous client events over the past several weeks about this sort of concentrated market and how much influence a small handful of stocks have had on the index. It's even more extreme in South Korea. SK Hynix and Samsung make almost 50% of that market. So you're beholden to two names, half the move of the index, all else equal, but you're more beholden to two names in what they are doing. Of course, it's a different economy and it's a different market altogether, but I think that the concentration risk is even more extreme in some of these other countries. Again, not to say that that's a bad thing, because when you capture that upside, it feels pretty great. But when you're on the opposite side of that, momentum takes a turn. Of course, we all know how that goes.
Lisa mentioned Nike. We're going to get earnings after the bell. Do you see a broadening out to other stories, or are you just all focused on AI?
No, I think you already have. I mean, I sort of sometimes joke that at the end of the day, when all of this is said and done and when the cycle matures, every stock becomes an AI stock because you're either a creator or you're an adopter. So I think that whether it's a consumer discretionary name or if it's a healthcare name, I could see benefits sort of trickling down ultimately to both of those sectors and really to every sector. But I think that in terms of a broader market story, some of it has actually started to improve over the past several weeks. When I look at Brett's statistics, they're sort of neither great nor poor. We're kind of hovering in this middle range of 63% of members in the S&P trading above their 200-day moving average. That is more, I think, indicative and consistent with the rotational market, not necessarily a strong bull market, but of course not a market that's, I think, at risk of entering a bear market because you're not seeing a divergence between that and price. So it has happened, but it's been in fits and starts. But I will say, though, even if you look at the first half of this year, so by the end of today, assuming we don't get some major move, you still have seen international outperform the U.S. You still have seen, participation from some of these deeper cyclical parts of the market. It has not just been U.S. tech. It has not just been U.S. or memory stocks.
At the end of last year, there was a real divergence between the tech trade and the stocks that were doing really well and the underlying economy.
Yeah.
And there was a question about how long this divergence could continue before one met up with the other. And it seems like on the margins, the U.S. economy is catching up to the tech trade. How do you expect that to show up in either the JOLTS data, the ISM manufacturing tomorrow, or the non-farm payrolls on Thursday?
I do think we need to be more attentive to some of these turns in what we have called in the past rolling recessions, but now turning into rolling recoveries. You're seeing that in the manufacturing data. It's interesting, though, because it's happening when services data is still kind of being held back a bit. If you look at the PMIs in particular, services have been more depressed, not just in the U.S., but if you have that dynamic where manufacturing is improving, but services is not, then overall growth is still being held back because of the services dominance here. But from a labor market perspective, I mean, it's unmistakable to look at some of these trends. The moving average in payroll growth over the past 3 months, the fact that the unemployment rate has been unchanged, has the potential to move a little bit lower this year. The fact that initial jobless claims have not, spiked, and actually, when you look at it seasonally compared to other summers, they're pretty low. So all of that is still pointing to, I think, a little bit of a washing out of the uncertainty that businesses had tied to whether it was Liberation Day last year, whether it was the war this year. And the labor market is going through kind of this rolling weakness, and it's not going through a full labor cycle. So I do think that we need to be more attentive. And of course, this matters most for the Fed, being more attentive to the fact that you could see a potential retightening tightening of labor this year. Not sure how extreme it would be in terms of fanning a lot of inflation flames, at least right now, but you need to be more attentive to that as an investor.
The task force is all over it. Kevin Gordon, thank you so much for being with us. Kevin Gordon of Charles Schwab joining us here in studio as we await those JOLTS figures coming out, the job openings data at 10 a.m. Eastern. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, Iran says serious challenges remain in U.S. implementation of the Memorandum of Understanding. Tehran is saying talks with the mediator in Doha today will cover frozen assets. The Trump administration is tightening federal student loan rules. The Wall Street Journal reporting that colleges that don't meet new graduate earnings thresholds will lose access to federal loan funding, with about 3,200 programs currently on track to fall short. In sports, Serena Williams makes her return to singles play at Wimbledon this morning with her first match in almost 4 years. The 44-year-old tennis icon will also be playing in the women's doubles alongside sister Venus later this week. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, the morning calls, plus Rebecca Babin of CIBC on the ongoing uncertainty in the crude market. That's coming up next. This is Bloomberg Surveillance. Good morning.
Things are still remarkably good, and I think the operative word remains resilient. Every time we get the challenges towards that resilience, it seems to be overcome by that resilience factor that either shows earnings better than expected, debt in better situation than it actually was thought to be. Fundamentals remain very positive.
That was John Stoltzfus of Oppenheimer, who was bullish, actually. He has been bullish for quite a while, but talking about how it is the earnings, which is something that we also hear pretty much every day. Again, these are stories that have been the themes for 2026. Right now, building on those themes, you are seeing ongoing resilience in U.S. equities. Futures now actually about flat on the S&P, having come off after having been up almost 0.2% earlier, fading throughout the morning. Maybe as a result of this, two-year yields climbing 4.12%, climbing about 2 basis points after already increasing more than 30 basis points over the past 3 months. Crude prices just inflecting a little bit higher, and that Japanese yen, just keep watching that, given the potential for some red line. Now it's a moving red line to be crossed at 162. Given the fact this is the weakest level for the Japanese yen going back to 1986. Time now for the morning calls. First up, Morgan Stanley raising its price target on Alphabet, calling this a tactical buying opportunity for, quote, one of the best positioned AI companies around. Those shares up 0.33%. Next up, Oppenheimer downgrading Citi to perform, saying it doesn't find its valuations compelling and recommends redeploying into alternative asset managers. Those shares lower by 0.8%. And finally, Wells Fargo boosting its price target on Delta Airlines, saying shares can perform even after the recent rally as fuel falls and demand holds. Meanwhile, crude heading for its biggest quarterly drop since 2020. Morgan Stanley cutting its price forecast for the second time this year. As Annmarie was mentioning earlier, warning of a potential glut. Bloomberg's Anthony DiPaolo joins us now. Anthony, just give us a sense of why you see these downgrades that are happening faster than people can keep up, given the fact that we haven't gotten a resolution in the Middle East.
Yeah, good morning. Well, we haven't gotten a resolution, but we do have the Strait at least partially open or more open than we had it during the conflict. So we have seen a real uptick in tankers going out, and that's what's really helping the price. And again, there is this idea that potentially the glut that we were so worried about going into the start of this year is returning. Part of that is because we have seen suppliers like Abu Dhabi, like Saudi Arabia, being able to continue supplying oil via pipelines that have bypassed Hormuz throughout the conflict. Now, with the Strait open, they're able to continue ramping up their exports through the Strait. Tankers had already been sneaking through even during the conflict, using that channel closer to the Omani coast, which a lot of tankers are still using. So we are seeing that additional oil coming through. Plus, we've got that Iranian crude now available in the market with those sanctions at least temporarily lifted. That comes into a market, again, where a lot of demand has come off just in the short period that there was that active conflict, Chinese demand came way off as they used a lot from stockpiles, as they cut domestic refining. Some demand has been destroyed in countries like India, where some chemical plants stopped. So that lower demand, coupled with those higher flows coming out of Hormuz, out of the Gulf right now, that's really that cocktail that's mixed up and that's contributing to those lower oil prices right now.
Thank you so much, Anthony DiPaola, for coming to us. Thank you for that. Morgan Stanley, of course, cutting its oil forecast, looking now for $70 at the end of 2027. So it's not just a near-term forecast, Annmarie, it's also longer-term, what we could potentially be seeing.
I think the signal from the White House has been really clear. We want to make sure that oil continues to flow. They didn't want to go into peak driving season with high prices on the consumer, and even with prices dropping across the United States, the president is still annoyed they're not dropping fast enough and actually going after, per Truth Social the last few days, retail gasoline owners, saying they're gouging and telling consumers that, you report them and complain.
Yeah, call President Trump with Joe from Sunoco. Rebecca Babin of CIBC Private Wealth writing, the market may be overestimating the pace of production recovery while underestimating future inventory rebuilding demand. Rebecca joins us now. Rebecca, you're one of the few who are holding on to this view that maybe oil prices are going to go up. How much pushback have you gotten recently?
So I get a fair amount of pushback, but I would say this, you keep referencing the Morgan Stanley price cuts this morning. Guess what? Their targets are still above the strip, where the strip is currently trading right now. So $70 at the end of 27 is still above where the market has crude right now, which is closer to, high 60s. So I think what's happening is some of the analysts that maybe have overshot of where they thought crude would go are coming back to where the market is now. So in terms of the comment of what I'm making is essentially we are effectively pricing in all of this supply coming back to the market in a very even and measured way, and that demand, which has been impacted due to this conflict, does not come back, right? So that's what's being priced right now. And to me, that's just a little bit overly optimistic on how quickly the supply is going to come back. We've already seen fits and starts here, and we did have a lot of Iranian crude sitting off the coast of China before the sanctions were waived. So that was immediate pressure on prompt, right? And we've also had this SPR release which has helped buffer this conflict. So we've had a lot of prompt supply, and we're anticipating that this just carries forward in a very measured way, and that the demand drop that came out of China as they cut refinery runs, and transitioned away from some of their more fossil fuel intensive petrochemical activities isn't going to rebound. And to me, that's just a little bit pessimistic. If you look at the headlines today, China has already said they're going to roll back some of their product export bans. Immediately, that is going to pull forward a little bit more crude demand. And I think that we're overestimating the downside just as we had overestimated the upside at the height of the conflict.
So where do you see prices ending the end of this year, Rebecca?
So I think we can look at the end of the year and I can kind of see Brent TI, I can see 75 TI, 80 Brent. And I just think that we don't necessarily see this even distribution of flows resumed through to 85. What I think is priced is 85% of flows resumed by the end of July is what's priced. I think that might get pushed out. And we don't necessarily we are seeing this immediate reaction as ships have transited and Iranian sanctions have been waived. But if that gets pulled back, I don't think we see the acceleration of inventory builds that the market's anticipating. So I'm not drastically above the strip. I'm kind of looking 75, 80 Brent TI.
What do you make of the conventional wisdom that then next year we're going to potentially have another glut?
So that is a really interesting question. I think 2027 is shaping up to be really challenging from a forecasting perspective. Right now, estimates have a surplus of about 4 million barrels a day for 2027. Some analysts are higher, some are lower, but that's kind of the midpoint of the range there. That is going to be very indicative of how aggressively countries decide to stockpile after this event, right? If all of those 4 million barrels surplus is just kind of, we don't need to rebuild inventories and it's just considered to be excess surplus in the market, we could see pressure in 2027 and we could see the strip trend kind of closer to that $70 level and TI, maybe 65. I tend to think, having read the headlines again this morning, that India says they're going to increase their strategic petroleum reserves. China has some rebuilding of stockpiles to do. India also wants to diversify away from Middle Eastern crude. I tend to think that's a scenario we're anticipating this massive surplus, but what it's going to be is a rebuild, and the market might not reflect quite as loose as that number kind of headline number would say. So I'm not thinking that we see this dramatic 60s, 50s crude scenario next year, which I know some analysts are pointing to. I tend to think we hover around this kind of 70, 75 level.
What has the OPEC waivers done for this market? The fact of the matter is Iranian crude could flow freely at market price.
This has been a huge factor, not just the OPEC, but the fact that you can transact in dollars, I think has opened up a lot of Iranian crude to the market. Now, what I haven't seen is a tremendous amount of buying outside of China of Iranian crude, but what that does essentially is make Iranian crude available to places like India, which has significantly reduced their imports due to the sanctions, and makes it a more competitive barrel right in the market that can press other things lower. Typically, Iranian crude traded at a huge discount because of those sanctions. It's now a free-floating market barrel, and that kind of just can press things lower. Now, this all assumes we're talking about a 60-day waiver here, so we don't know how that shakes out and if it'll get reimposed. But for now, it's certainly the reason we're seeing the weakness in the prompt market, which I don't necessarily disagree with. When I look at the risk reward here, I think we've priced in a lot of a really optimistic scenario. And should that not play out, I think we have more upside than we do downside at current prices.
Rebecca Babin of CIBC, thank you so much for being with us. And as we're talking, we are getting some commentary from Treasury Secretary Scott Bessent saying that we'll see if there's price gouging by oil companies, encouraging gas retailers to be good actors.
I feel like we heard the same rhetoric from the former Treasury Secretary Janet Yellen and the former President Joe Biden, and then the Democratic nominee candidate Kamala Harris when it came to groceries. It's interesting.
Prices are always too darn high. Coming up, we're going to be speaking on the JOLTS data coming up later this morning. We had been up, now we're down. Right now, it just essentially fluctuating around as we start a day after what could be a quarter that is the best quarterly performance going back to 2020. Just a touch lower on the S&P and NASDAQ futures. Russell 2000 taking a leg even lower, down 0.25%, as you do see yields climbing. And this could be what's behind it, given the fact that 2s, 10s, and 30s are seeing a lift after having been lower earlier, up about 2 basis points through 4.122% on the 2-year yield. Remember, that's up more than 30 basis points in the past 3 months as people start to price in rate hikes. You see less of a move at the long end of the yield curve. 30-year yields 4.87%. Nonetheless, this all coming with a backdrop of oil prices that had been lower. They have been significantly lower over the course of the past month, 2 months. You're seeing them inflect just a little bit higher as you do have a little bit more heated rhetoric coming from Iran and questions over exactly how this is going to go forward. I mean, you're shaking your head a little bit because it's sort of like, how do you gauge this out? It does seem, though, like this story hasn't been completely tied up in the way that some people would like.
Well, of course not. We don't even know, Lisa, today, are they meeting face to face? The president alluded to the fact that there will be this meeting in Doha. Jared Kushner, Steve Witkoff are going, but the Iranians are saying, well, we have officials there, but we're not meeting the Americans. So is it all being done by Qatari interlocutors? How much can actually get done in the 60-day period if that's how you're establishing how these meetings are going to go?
It always sounds like a cloak and dagger. Go to the mountains, find somebody, find a place to talk to someone who can talk to somebody else who can talk to my uncle. 1 hour away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We are seeing solar stocks catching a bid this morning with names like Enphase up nearly 12% in the pre-market on some potential policy changes. Reuters is reporting that the Trump administration is drafting a ban on imports of solar inverters made in China, and that is due to national security concerns that, of course, could benefit these domestic suppliers since it would limit competition from Chinese suppliers. Turning to Joby Aviation, this is an electric air taxi company whose aircraft are still not up in the air, but its shares are rising 6% after it announced it is establishing a joint venture with Toyota to ramp up production and get closer to commercial air taxi services. And we end on Digital Realty. These shares are down nearly 5% in the pre-market after agreeing to buy Blackstone stakes in 3 Northern Virginia data centers for $3.5 billion. This, of course, expands its footprint in the world's hottest AI data center market, but investors are focusing on the financing since Blackstone is immediately selling at a discount the roughly 12 million Digital Realty shares that it is receiving in the transaction. So some short-term pressure on the stock. Lisa?
Thank you so much, Yahaira. Meanwhile, investors awaiting fresh reads on the U.S. economy. At 10 a.m. Eastern today, we get the JOLT State of the Job Openings data leading up to Thursday's payrolls report. Look out for the quits. Bloomberg Michael McKee joins us now. Mike, we have seen some better than expected prints. What's the expectation this time around?
Well, this time around, we're expecting a little bit of a decline in job openings, but that's May data, so it's not quite as useful as maybe what we get from the Conference Board today, because the Conference Board confidence numbers are heavily influenced by what's happening in the job market. We'll see what people think about that. And then, of course, we get Jobs Thursday this week because Friday's a holiday. And right now, we're looking at 110,000, but that may change as we get these additional data points between now and then. The 3-month average has been 188,000, if you can believe that, and that is likely to come down a little bit if we get that 110,000, but it's still a strong number, and no change in the 4.3% unemployment rate. The question is really, though, average hourly earnings. They're expected to tick up just a little bit, and average hourly earnings have been, as you can see there, falling below CPI inflation, about 3.4% the last month, and then CPI inflation last month, 4.2%. So Americans are falling behind on that, and that has some implications in 2 areas, both in the economic area. Stronger hiring would help, but it raises inflation questions if we start raising those average hourly earnings. But if we don't, with earnings falling behind, you've got an issue for candidates running for office this fall because affordability is not a hoax. People are really feeling it at this point. So the data we're getting this week, starting today, really going to matter going forward.
Yeah, Michael McKee, thank you so much. Really looking out for that quits rate, too, which has been key to really understanding just how much people feel comfortable saying, sayonara, let's check out some other place. Lauren Saidel-Baker of ITR Economics writing the current job market stalemate of low hire, low fire is likely to transition to a more moderate hire, low fire mode later this year and into mid-2027. Tepid enthusiasm for recovery. Lauren joins us now for more. Lauren, thank you so much for being with us. So what makes you feel like we are on an upswing here, where there is going to be, I don't know about a tightening labor market, but certainly a more positive spin to it?
Yes. Really, as we look at labor market dynamics, employment is a lagging economic indicator. We look for consumer strength in these numbers, right? We're using it for so many other inputs, but at the end of the day, the employment numbers do tend to lag behind things like retail sales, some of these more macro indicators. So we have leading indicators here that are showing us last year's pessimism or uncertainty that was so elevated. That's really been keeping employers in this low hire, low fire mindset. And that's likely to lag through, I would say, the first half of this year. However, we've seen these metrics pick up, right? We're starting to see more optimism out there, especially on the business side of things. So that's why we're looking for, again, only tepid enthusiasm. This is not flipping a switch and seeing everything come roaring back to life in the second half, but we are seeing those early green shoots, those early signs of rise. That is what I'm expecting to start seeing coming through the labor data.
What kind of jobs? Is this going to be World Cup concession stands jobs, or is this going to be data center build-out jobs? Is this going to be people in financial centers? I mean, how important is the mix of jobs getting created to you?
The mix is critical. What we saw, especially in the past, let's say 18 months, was really jobs concentrated in non-macro driver sectors. So by that, I mean things like education, healthcare, things that just don't tend to correlate to that macro cycle. And they're really not the drivers of job creation. Now, we're increasingly starting to see more jobs in things like transportation, wholesale trade. Those are a little bit more fundamental to our economy. But if we stay in this kind of government and healthcare sector as the only job creators out there, that's very unbalanced.
John's not here, so I'm going to ask the question. If there's a moderate hire, low fire, the individuals that are moving to new jobs, can they ask for higher wages?
Yes, and I think they will have to. They know what cost of living is doing. As Michael mentioned, the affordability constraints are very real across a broad swath of our consumer base. And so I think employers are going to have to budget for higher wages. We at ITR Economics do see inflation picking up, not continuing to cool down. And that's going to be a bigger part of the equation here. Now, for the consumer, really that critical metric is real income, so inflation-adjusted incomes. If we do, in fact, see wages continue to outpace inflation, I think we're at a tipping point right now where that isn't quite the case. That could be a real risk to the macro outlook.
A wage price spiral? Is that the risk you're thinking of? That potentially an issue for the Fed?
I certainly hope not. I don't think we're getting to that point. Again, inflation is very broad-based in this cycle. It's not just energy prices. It's not just all of those tariffs that we are so fond of talking about, but really these broader implications. There's a lot of liquidity out there, money supply ticking back up, right? We see these more fundamental drivers, not to mention things like energy prices. You mentioned those data centers. They are just driving rates up, not only for data centers, but for residential rates as well, for other businesses. So I think there's going to be a continued margin squeeze. And the question for me, especially as we get closer to 2027, is just how much of those price hike the consumer is going to still be willing to accept.
Well, we have seen the consumer to be incredibly resilient, whether it is higher energy prices earlier this year with electricity costs, higher energy prices at the gasoline pump. We just heard Mike McKee talk about affordability, but the fact of the matter is consumers continue to be resilient. Are you seeing parts, though, of the consumer cohort that is actually struggling right now?
Never count the U.S. consumer out. However, in this macro environment, yes, we hear about that K-shaped economy just so frequently. And that really is the case here. The bottom end not doing quite so well. They are feeling the pinch. They naturally do get hit harder by some of these trends we're talking about, like higher inflation, especially with those non-discretionary purchases. But middle to upper income earners, they're actually doing quite well right now. They're, first of all, sitting on real wealth effects, things like my home being worth more than it was, my stock portfolio doing very well, as you quoted in the numbers earlier. And it turns out that it's those middle to upper income earners that really drive the bulk of retail spending. The consumer at the end of the day drives 2/3 of gross domestic product. So as that especially upper income earner goes, so will go our economy.
I'm just wondering, Lauren, I know that right now we're hearing commentary coming from the Sintra conference, and they're talking about inflation, they're talking about the risks, they're talking about oil prices, but they're also talking a lot about AI, not necessarily as a CapEx boom, but in terms of concentration risk with respect to markets and how this could become a financial risk that really does torpedo economic growth. How much are you watching some of the market moves tied to AI and the connection between the economic trajectory in the United States?
So if AI and data centers are a bubble, I don't think that bubble is bursting immediately. Really what I'm looking for as a macro driver is, can AI make us better? Can we actually see better productivity? Thus far, there are some tentative signs that we are seeing an upward tilt there, but I think the jury is still out. It's just too soon. The effects are not grand enough. And if you go back and compare this to the gains that we made in, say, the 90s with the advent of the personal computer, the internet, that's where we really see what a shift in technology can do. So I'm thinking of AI as just the next iteration. Yes, some companies will be able to harness it. That will help them. Again, I mentioned this margin squeeze. That's going to be a very real differentiator for firms out there. And if these companies are willing to invest in AI, and not just invest in a throw money at the problem kind of way, but really use AI to solve a problem, that's where I think we're going to see the winners.
Lauren Saidel-Baker of ITR Economics. Thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, thank you. Venezuelan opposition leader Maria Corina Machado is trying to return to her country to help with reconstruction efforts after 2 earthquakes last week. She says she was unable to return because the government closed its airspace in an effort to block her arrival. Despite being one of 23 underwriters, South Korea's Mirai Asset Securities received no stock allocation in SpaceX's IPO. Sources telling us here at Bloomberg the issue was a misunderstanding over how orders were supposed to be submitted. The company is now apologizing to clients and being inspected by local regulators. Paraguay delivering the biggest upset so far in the World Cup, sending 4-time champions Germany home in a dramatic penalty shootout after they finished at 1 goal each following extra time. It was Germany's first appearance in the knockout round since they last won the tournament in 2014. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. I have to say, it's incredibly dramatic when it comes to shootout, but it feels deeply unsatisfying because ultimately, after all that work, all the domination of Germany in the first half, and nothing, right? And there's sort of this feeling of just interpersonal rivalries and internal angst that you can feel with all of the potential kickers.
Oh my God, yeah. I mean, I grew up playing soccer. I played for most of my life. You run around for 90 minutes. It comes to a shootout and you lose. It is so upsetting. I think today is actually now a national holiday in Paraguay because of this huge win.
Congratulations to Paraguay. Up next, setting you up for the day ahead. Plus, David Rubenstein of the Carlyle Group as Fed Chair Kevin Warsh takes his new policy regime on tour over to Sintra, Portugal, which really looks beautiful. This is Bloomberg Surveillance. Good morning.
I don't know that anything dramatic will happen between now and year end. The amount of money sloshing around the system, all the capex that's going on in the U.S. and globally will start to accelerate growth and inflation pressures, and the Fed will have to come back in next year and hike rates once or twice. This is not a dramatic hiking cycle.
That was Bob Michael of JPMorgan Asset Management. The debate seems to be not necessarily what the Fed will do this year. A lot of people think maybe a hike, but more likely on hold. It's next year. Is it going to be a hike or is it going to be a cut? Right now in markets, you can see a fading of the optimism earlier this morning, although S&P futures just about unchanged. 2-year yields 4.12% up, nearly 2 basis points. Brent crude has been fluctuating around all morning, just essentially flat at $73 on Brent. And you can see that Japanese yen continuing to weaken. The weakest levels going back to 1986. A question over to you, Bank of Japan. What you gonna do? Counting down to the opening bell. Here's a trading diary for the week ahead. At 10 a.m. Eastern, JOLTS data and consumer confidence after the close. Nike earnings. How goes the turnaround that hasn't really led to any kind of pop in the shares this year? Wednesday, ISM and ADP data, plus Fed Chair Kevin Warsh. What does he stand for? What will he say? He will be speaking in Sintra, Portugal, Thursday. The June payrolls report, and on Friday, you get a day off for the 4th of July, the U.S. Independence Day. Looking ahead to the Fed Chair's international debut, Kevin Warsh taking the stage tomorrow in Sintra, Portugal, alongside global central bankers. David Rubenstein of Carlyle joins us now. David, thank you so much for being with us. Always great to get your thoughts. How much are you looking at this moment as an inflationary one that requires higher rates as a result of some of the dynamism that we're seeing in other pockets of the economy?
Clearly, the ECB has raised rates recently, and other central banks around the world are raising rates. But Kevin Warsh clearly has a mandate not to increase rates all that much. And I think President Trump is not looking to him as somebody who's going to raise rates very much. The most recent meeting, the Fed did not raise rates. And I suspect that Kevin Warsh will wait as long as he can before raising rates. President Trump has a lot of confidence in Kevin Warsh, more than he did for whatever reason in Jay Powell. So I think Kevin Warsh can raise rates if he needs to, but I think he'll get less criticism from President Trump. But I think he would prefer to hold off doing that for quite some time if possible.
David, do you think that he needs to? Do you think that right now the inflationary pressures that you're seeing coming from AI, whether it's in portfolio companies, whether it's in just business more broadly, are something that is going to be sticky and requiring of a policy move?
There are inflationary pressures coming out of the war in Iran, for sure. Oil prices have been up for a while, and while they probably are going to recede, I do think there's some residual inflation, but I suspect that the Federal Reserve Board can wait another quarter or so before deciding it needs to raise rates. And I'm not saying it will have to, but Kevin Warsh is a very smart person. He's got the president's confidence. Unfortunately, Jay Powell did not have the president's confidence, so I thought he did a good job. But Kevin Warsh, I think, was going to have much more leeway to do what he wants to do than Jay Powell did.
David, when you say clearly has a mandate not to raise rates, you mean he clearly has a mandate from the President of the United States? Are you then insinuating that you don't think he's truly independent?
Well, I think he is independent, and I think he's very strong-willed, and he's a very smart person. He's got a lot of experience. He's been on the Fed before. But I think it's the kind of situation where President Trump relies on him more than he probably does on Jay Powell. He's known him for a longer period of time. He's known his family for a long period of time. And I just think he's going to give him more leeway. That doesn't mean that Kevin Warsh is not going to raise rates. I suspect he'll do what the numbers indicate he should be doing. And I do think he will effectively control the Federal Reserve process. And what he wants to do, I think the Federal Reserve will go along with.
What do you make of his performance thus far? No dot on the dot plot. He's not going to give forward guidance. He has these 5 task force that, maybe by the end of the year we'll have an understanding of what they decide to report out. Do you think this is the right approach?
Well, remember, Alan Greenspan was chairman of the Fed for 18 years, unfortunately just passed away, and he did not give the kind of guidance that Jay Powell did. Ben Bernanke gave some guidance, but not as much as Jay Powell did. So it's not as if the Federal Reserve has always given the kind of guidance that Jay Powell did. I do think Kevin Warsh thinks that the Fed should be a little bit less transparent, not be so open about what it's thinking, and I suspect you'll see less transparency and fewer press conferences than maybe Jay Powell had. I think Jay Powell did a very good job in explaining what the Fed was doing, but some people, obviously Kevin Warsh, one of them, think that the Fed should be a little bit less transparent.
David, we're talking about the central banking universe as this meeting takes place in Sintra, and they're talking as much about traditional economics as they are about AI stock valuations and concerns about what this does when it comes to systemic risk. As a business owner, as someone in markets, are you getting concerned about valuations getting ahead of how quickly we can deploy some of this technology in productive ways?
Enormous amounts of money is now going into AI and going into data centers. And the theory behind investing is you get your money back with a return. Whether you'll get your money back with a reasonable return on all the AI investments is unclear at this point because so much money is going into this area, and it's not clear when the returns will come back, if at all. So I do think there's reason for caution, but I don't think it's a concern right now that AI will be a bubble that will burst dramatically. I do think there's a lot of interest in AI, and I think for some time you're going to see a lot of investment dollars going into it. And I think a lot of them are justified because AI is clearly going to change the way we live and the way we deal with business, just the way the Internet did. Whether the Internet had a bubble or not at some point in time is something that you can say maybe it did. AI could have a little bubble at some point. But right now, I think the markets are still fairly resolved that AI will be a pretty good thing to invest in. And there may be at some point in time, there might be some slight reduction in the values. But generally, AI is here to stay, and enormous amounts of money are going to go into this area.
Yeah, something I'm sure that you talked about online and offline with Rick Wurster in your latest episode of Bloomberg Wealth, which we'll get into in a second. How much do you see AI and some of these large language models transforming the asset management industry, not just on the retail side, on the private asset side, in your business, what you're doing?
Well, AI is here. They're going to change everything. For example, in the investment world, AI models are being used to assess whether a deal is a good deal or a stock is a good deal. The models will get perfected over a period of time. But I do know that some private equity firms are beginning to look at AI as a help in making decisions about whether to proceed with certain investments or not. I know in my own firm, in certain areas, we have used AI quite extensively to help us speed up the decisions that are about to be made. For example, if you're looking at a large portfolio of investments, you can make the decision about whether they're good or not much more rapidly with using AI technology.
This is something that I think Annmarie wants to know about, which sports teams you're going to be using AI to purchase next, or whether you're going to be advising the Knicks. Is that right?
Well, David, I know that you recently were at an NBA meeting and gifted the Declaration of Independence a replica. I'm not going to nudge you about the Orioles, but if you were Mr. Dolan, what would you do right now with the New York Knicks?
I think I have enough problems dealing with my own baseball team and challenges, so I'm not going to give any advice to anybody else. I think each person should deal with their own situation, and I'm hardly one to give advice at this point. But I'm optimistic that baseball is going to be more and more popular increasingly, and I do think that that Major League Baseball will thrive the remainder of this season, and I'm quite optimistic about the attendance at Major League Baseball games and the fan viewership. So each owner has to deal with their problems themselves or their challenges themselves, and I'm not one here to give advice to others.
David Rubenstein, you're a legend, and it's always wonderful to speak with you. David Rubenstein of the Carlyle Group. Do not miss David's conversation with Charles Schwab President and Chief Executive Officer Rick Wurster on Bloomberg Wealth tonight at 9 p.m. Eastern, right here on Bloomberg Television. A key conversation at a time of transformation in the financial industries, especially given what we've talked about throughout the show, AMH, which is essentially retail investors having a much more powerful seat at the table and a much more active one.
I think really interesting, David's talking about there that he's using it in his own portfolios, figuring out how quickly you should make an investment and how AI is speeding up decision-making, that whole entire process that sometimes can take weeks or months. How short is that actually becoming now for investors?
Yeah, it's here to stay. Just question of valuation and just where people are seeing the potential profits and return therein. Coming up tomorrow, do not miss this. Brian Levitt of Invesco, Libby Cantrell of PIMCO, Andrew Hollenhorst of Citi, and Jim Bianco of Bianco Research. I think Jonathan Ferro will come back from his visit to Sintra. I think that he did take the ticket, and then he will join us back again tomorrow because evidently the short junket was enough for him. Right now, we are seeing markets just rolling over a touch. From New York, this was Bloomberg Surveillance. Good morning.